I have to leave it alone.
Okay, we'll put them, if it's all right, right after our panel discussion. Put the business items that carried over from yesterday. Is that okay? Here, no objection. We'll pick up the carried over items after the panel. Now we'll turn it over to the discussion staff and our panel guests.
Good morning, everybody. We're continuing our panel discussions from yesterday. This morning's first panel is a panel on the hedge fund industry, market, and opportunity set. And we've got several of our hedge fund partners with us today. I will let Dave Phillips introduce shortly. But it's really our theme is debating the hedge fund promise. And as you know, we assumed responsibility for this portfolio, and it was a 50-50 long-only portfolio that we found about 95% of our risk being long equity exposure. And we systematically tried to manage that risk and better balance it. One of the first areas that we made a special emphasis on was absolute return strategies, attempting to be able to generate alpha that was sustainable and stable and rather uncorrelated with the underlying market indices, and also provided a decent amount of liquidity. And the theme really is to evaluate the hedge fund promise. You know, have hedge funds really lived up to that role in the portfolio? We had a lot of issues with liquidity, particularly in 08, and gating of certain funds. We've learned a lot about embedded beta in different funds that maybe made us approach funds with a stronger view of which ones may truly be considered liquid absolute return strategies versus ones that in and of themselves are more of an exotic beta that can be treated as such, and understanding the liquidity as such. I think the industry itself has really made a lot of reconstruction in terms of moving more illiquid or directional trades in separate share classes or separate funds, and trying to get back to the hedge fund promise, I suppose. And when you consider where we are in an extremely low interest rate environment, can the alpha generation really justify the cost structures of these vehicles? So we've got a lot of things we'd like to explore here, but this is a very material part of our program, north of $5 billion of assets. As you know, we have a systematic plan in place to have a more optimized portfolio. When we began this foray into absolute return strategy, we had hoped that we would have about a 50-50 mix of direct or multi-strat funds versus fund funds. What we found, in order to get the due diligence done adequately and be able to move with expeditiously enough, that we had to rely a good bit on fund funds. Where we found ourselves 3 years later was perhaps over-diversified. We have over 350 underlying strategies, and we have reconfigured this portfolio basically to center on some strategic partners, all of which are in front of you today, from Blackstone, Entrust, Grosvenor, and Lighthouse, to help us reconfigure our program to be adequately diversified but not over-diversified, to be a little more fleet of foot in how we allocate sub-strategies in space and time, and attempt to get better clarity and roll-up and risk management in this space. So we're just starting that, really I'd say the whole phase 2 of our absolute return program. And with us today is going to be really the future of that program, these 4 partners. So Dave, would you like to kick it off and introduce the speaker as well?
Good morning, everybody. We're very pleased to have leaders from 4 of our most significant strategic partners with us this morning. So the far left is Michael Purvis, who's the head of investment research for Blackstone Alternative Asset Management. serves on BAM's investment committee. Next is Greg Heimowitz. Greg is co-founder and managing partner of Intrust and chair of the Intrust Capital Investment Committee. Next is David Richter, who is representative and leader, chief investment officer, and chairman of the firm's investment committee at Grosvenor. And then lastly, next to me here is Sean McGould, who is the founder of Lighthouse, chairman of the Lighthouse Executive Committee, and a leader of the Lighthouse Investment Committee. So guys, we'll keep it really informal and kind of free flowing here. Scott mentioned, we know what the premise was for hedge funds going back a number of years. And we know what kind of the end goal of what we'd like to see. Can't quite get the stars to align for us, but Mike, maybe if I can start with you, just taking a step back at the very basic level, what is, in your mind, the current definition of a hedge fund?
Well, very simply, a hedge fund is a, and I'll get into a more serious answer, but a hedge fund is a compensation scheme as much as anything else. Hedge funds charge a performance fee, different from a lot of long-only, and encompass a wide variety of strategies. About 50% of the money in hedge funds is in long-short equity, and if you look at that group, they probably have a beta of 35 to 40% to the developed market equities. From there on, strategies like trend followers are somewhat material, but you can't imagine an asset class which has not got a hedge fund associated with it. You know, our view of hedge funds is where they're most useful is where they pursue niche markets, where they're doing something that you're not going to find, you know, in a broad-based asset class, which is quite frankly more efficiently priced, and where they can bring expertise, you know, that will generate a return that really makes sense on a risk-adjusted basis. And that risk really varies. So there are strategies which are really uncorrelated. Everything has its own risk at a particular moment in time, but there are strategies, there are also people who are 100% long and efficient from that standpoint that go on, you know, under sort of the hedge fund label.
Yeah, I mean, I guess I would add that I think at the heart of it, hedge funds are designed to basically preserve capital or mitigate losses when markets dislocate. And at the end of the day, much of investing, I think, is what we learned, particularly through the credit crisis, is the law of numbers, right? If you're down 50%, you have to be up 100 to get back to even. If you can preserve capital in these difficult dislocation environments, the upsides often take care of themselves. So in general, most hedge funds have, I would say, less constrained investment philosophies or less constrained investment guidelines. If they feel the need to go to cash or reduce exposure significantly in the event of a dislocation, they can do that. And then by building liquidity, they can also take advantage of opportunistic environments. But I think actually, I know part of the panel is about, or part of the questions are about, has hedge funds fulfilled their promise? You know, I would tend to look at just sort of the credit crisis as way of an example. If you look at the credit crisis, the equity markets peaked in November of 2007. So my numbers are roughly through sort of the end of last week. U.S. stocks still need to be up about, call it 18% to get back to November 2007 values. European stocks need to be up about 60% just to get back to November 2007. I know every fund to fund up here is different. I can only speak for ourselves. We're about 5% above November 2007. Now, obviously, I don't think it's, you know, you always like to be better than that, but still, I think in many respects, hedge funds have actually delivered on their promise through this credit crisis, and that's why I think you see assets in the industry at peak assets today. I mean, I think every one of us, I know these two guys next to me, I see them all the time in competitions. The amount of money flowing into the strategies is significant because I think investors are realizing that through the credit crisis, hedge fund strategies have actually been one of the best places to put money relative to the more traditional strategies.
Just one thing to add in terms of definitions. People like to generalize when we talk about hedge funds. We like to think of hedge funds as simply best-in-class global investment managers. They're not homogeneous in any way, and the flexible mandates allow them to just adapt to changing conditions. So we like to have, so we think of hedge funds in all asset classes just as competitive asset classes.
And we think of it very similarly. We think of hedge funds as just the ultimate form of active management, being able to go long and short unconstrained. We really see the world kind of bifurcating into extreme active management, typically in a hedge fund format, and then passive management and ETFs and other index-based strategies.
Mike, I think it was you mentioned hedge funds associated with asset class. I think it's correct. One of you guys mentioned you would be hard pressed to find an asset class without a hedge fund associated with it. I think that brings up an important point for us. I'd like all of y'all's perspective on what you've seen in terms of large funds, how they treat the allocation at the fund level to hedge funds. So from our perspective, we actually have hedge funds as de facto listed as an asset class. And that I would, I guess, ask you, do you see more of that, or do you see more of hedge funds as an implementation for specific asset classes?
Right. So, David, I think the answer is the dominant use is as a separate asset class, as something that is protective of capital, that is neutral. To the point that was made, hedge funds, because of the fee arrangement, one of the interesting parts of working in the industry is you're entitled to get the best. You're paying for it, so part of the interesting thing is really, is there that edge? So most people allocate as a percentage of the portfolio, and that percentage of the portfolio is supposed to have a low correlation to other asset classes. That's been changing a little more recently. Certainly some public plans pursue different alternatives. One is as an equity substitute. So if a classic long-short equity manager is doing some hedging and can generate a return above above the indices from that standpoint, you're getting hopefully a good part of the upside with limited downside. So we see some people doing that. And this isn't about us, but we've used hedge fund managers in really very high beta products to bring the alpha to it, and people have used that in terms of allocating to asset classes like commodities or equities from that standpoint, which is really just using the talent. But that's still relatively unusual to find an allocation which is coming out of something like an equity bucket or a commodity bucket.
So the fact that hedge funds exist in all of the different strategies and asset classes is accurate. I would also add that they have an advantage, hedge funds have an advantage over many traditional firms because structurally speaking, they can own securities that many traditional firms can't own. And a hybrid debt, equity securities, structured credit type, distressed corporate credit in many cases, regulatory capital trades. So they just structurally, the proprietary trading desks are less active today, in many cases eliminated. So there's less competition and the structural advantages that hedge funds have across strategies.
I would say from our perspective, if you can understand the underlying instruments that a hedge fund is trading, so if they're equity-based or credit-based, I would argue that looking at it from that perspective is probably the way to go. So bucketing equity long-short strategies with other equity strategies, bucketing credit-related strategies with other credit-related strategies. I don't necessarily think of hedge funds as an asset class because they do so many different things. And I think with the availability of data and integrating it into more traditional portions of plans, I think you get apples to apples comparisons, and I think you see where some of the true benefits of hedge funds actually starts to come out when you compare them correctly with traditional assets.
So Sean, along that lines, if you take the hedge fund as a part of a traditional asset class category, how do you then begin to incorporate the performance measurement expectations and then the compensation part of it? Is it based on benchmark within that asset class, or is it truly a alternative absolute return stream on top of a risk-free rate?
Well, I think at the end of the day, we're all after returns. You know, the plan certainly has certain liability obligations to meet. So these strategies have to help achieve those goals. So if you have an equity long-short manager, you are going to benchmark them towards more traditional assets. I think you can measure how much idiosyncratic risk and how much stock selection risk they're bringing to the table. And if that's really what you're after, and isolating that, I think you can measure it and determine the benefit of that. I think hedge funds have proven that they can protect capital and help smooth returns over time, which I do think helps with liability management when you have money going out the door. But I think there's a couple different ways to look at it. But I think hedge funds, you know, net of fees have to be competitive with the asset classes that they're participating in.
What do you think the standard is for the alpha, if you will, over any of the asset classes? Can you generalize?
I think it ranges by asset class, but I would say somewhere in the range of 3 to 6% would be, I think, a fair target for pure idiosyncratic stock selection, security selection type of performance.
Do you not, when you attach it to the underlying benchmark, is there not an implicit assumption there that you have some beta component to that return?
In equity long short, in most strategies, as I think Michael was pointing out, there is a beta component, and it's going to range between 0.3 and 0.5. And that's another reason why I think you can, lump it in with more traditional equity allocations and view it that way. In other strategies, if it's market neutral equity, certain types of futures trading, certain types of credit-related strategies that are more neutral to the underlying asset class. I think there, again, you have to be able to benchmark it against something to measure what the managers are bringing to the table, and that measurement has to be done net of fees. Hedge funds are not the cheapest vehicle out there. They're not designed to be that way. The managers should be talented and can be compensated accordingly, but they have to earn it.
Greg, I'm interested in your statement that you think the hedge funds have delivered on the promise, and we'll ask you to draw on your experience at Intrust. I believe it was during the month of September for performance. All active managers besides the tail risk category were down, and the tail risk was up as it should have been. So can you kind of speak to your point of belittling, I guess on a relative basis, what even the negative components of your managers produce relative to the beta markets out there, and how that promise came through?
Yeah, that's fine. Look, I mean, as David said, we have a bunch of managers in the portfolio that are very much focused specifically on just these, what we call tail risk events. So managers that are much more focused on preserving capital in these sort of very difficult, volatile dislocation times. As David said, in September, those managers did incredibly well, and obviously for this year, in this volatile period, they've done extremely well. My point about hedge fund managers delivering on the promise through the credit crisis does not mean to imply that hedge fund managers are always positive. I think the lesson learned from 2008 among investors, and frankly some hedge fund managers, is that the idea of hedge funds is not necessarily that they're going to deliver positive return every single month, particularly when you get these correlations that tend to move towards one during these dislocation environments. The point, though, is that I think a good hedge fund manager and good fund of funds should deliver significant mitigation of losses when markets go down. So if you looked at, for instance, our fund, since inception of our fund, when the S&P is down, we lose on average roughly 28% of what the S&P loses. So for every $100 the S&P is down, we lose $28. If you could do that and participate in a relatively meaningful way on the upside, it takes care of itself. So, when you get difficult periods like a September, my guess, without even looking at the managers, as I sort of know that I'm going to be down, because we've been doing this now for a long time, somewhere in that neighborhood. Obviously, there's environments where you get correlations that move closer to 1, like we saw in the credit crisis, that gets a little worse just because strategies tend to correlate more. But in general, like I said earlier, I think if you don't look at it on a month-to-month basis, which could drive us all crazy, over a reasonable period of time, and I think the credit crisis is a pretty difficult period of time to have done it, hedge fund managers in general, not every one of them by any stretch of the imagination, but in general, I think have done a pretty reasonable job of preserving capital. I think, though, I would just say one other thing, I think, though, that, from an institutional perspective, fund of funds and hedge funds have now been in many institutional portfolios now for 3, 4, 5 years. When I first started doing it in the institutional world a decade ago, not a lot of U.S. institutions had a lot of exposure. Today, they've lived with exposure for 3, 5 years, and they've rotated out of managers that haven't performed. So I think now folks have a longer history with hedge funds or fund of funds, where you're seeing more and more of this rotation between folks who have performed and folks who haven't performed. And we obviously do that internally within our portfolio as well. But in general, I think they've done a reasonable job of preserving capital in some obviously very difficult times.
So I'd like to add, sometimes it's a long-term versus short-term measurement. The high correlation environments like in September, August and September, sometimes mask the skill of the hedge funds, because a lot of hedge funds are fundamental research oriented and they're good stock pickers and credit pickers, and they can really add value. And sometimes in those environments, some of that skill is masked. But even in those environments, they tend to lose, including September, much less than the broad markets. And as Greg said, and I agree with it, that recipe over time, you can lose less and it's easier to recover from, and you can adapt your portfolio to the changing conditions. It's really powerful. And you could look at all reasonable measurement periods, including those small periods of negative alpha, and you come up with an attractive result.
Well, I think, I guess moving into the really important point for us, all of you guys bring a unique perspective on a unique framework around risk management. So David, if I could ask you to continue, like everybody actually, to comment on either the risk management perspective at the fund manager level or at the individual hedge fund manager level. Recognizing there's a difference between the two. For us, at the fund level, it's probably more applicable to how we want to manage our exposure. But then you guys have to interact with the capabilities of the individual managers that you have in your portfolio. So could I ask you to give us your framework on that?
Well, David, both the underlying funds and the fund of funds all learned lessons from 2008. I think the underlying funds improved their risk management, they improved their liquidity, they improved their counterparty structures, they improved their own stop loss types of rules or other processes that they had. They improved their stress loss scenarios and severe case loss scenarios. So clearly they made improvements. At the fund of funds level, we've all made improvements too. If you look at and it goes from process in terms of risk management, qualitatively, I think quantitatively, the types of stress loss scenarios we do are more robust. I think that we have improved our own liquidity management of the underlying funds, our monitoring of their counterparty risk. I think risk management for institutional investors needs to be centralized. Better to have an understanding of how your hedge funds and fund of funds and traditional funds and all of your exposures all blend together in terms of correlation and exposures. And so risk aggregation, we think, is pretty important, and really understanding the exposures and trying to apply them consistently across asset classes.
I guess I would say, first of all, when you think about risk management, at least when we think about risk management, it's really two things. I know you're focused on, obviously, investments, so I'll focus on the investment as well. But I'd be remiss to not point out the fact that one of the most important things fund-to-fund managers do is the risk management on the operational due diligence side, avoiding the real pitfalls in the industry. So obviously, there's a significant amount of focus, and I think everyone on this panel would agree that that's sort of first and foremost. You have to make sure that the folks you're doing business with are best of breed across the board. But from an investment risk management perspective, I would say the most innovative or creative thing we've done recently is at the request of some of our institutional clients, we've actually built out a fund which we have not opened actually yet to the public or to outside investors, but we think we'll do it probably early next year, which is this fund which we call PTR, which is called, it stands for Portfolio Tail Risk Fund, which David alluded to earlier. And it's basically a bucket of managers now within our regular flagship fund, which all they do is focus on this left tail risk event. So these are the massive dislocations, so 6 standard deviation moves, which statistically are supposed to occur every 1 in a million years, but recently they've been observed every 3 years. Gives you a sense of the time we're living in. So, as David said, we have a number of managers in this bucket which serve as a protection, a way of mitigating these losses. Now, the problem is how you size this bucket, right? Because it's a little bit like you're paying away premium to protect the portfolio. And you can imagine in this environment, most of these managers have not identical, but there's common themes, right? Sovereign CDS protection against Europe and some of the emergings, investment grade credit spread widening trades, all sort of focus on the common denominators when risk increases, what happens to capital markets. So that's done obviously extremely well. I mean, that bucket of managers is probably up around 20% this year. The problem though is, and this is what makes the business so difficult, is how you size that. Because the swings we've seen have been very volatile. You'll get a September, but then you'll be followed by an October where markets rally 12%. So it's very difficult at times for hedge fund managers in general to navigate on a short-term basis those extremes by adjusting exposures as rapidly as one needs to. The more nimble obviously have done better. But from a risk perspective, the thing that we've done, which I think has helped mitigate some of the volatility on the downside, is this group of managers focused purely on tail risk. I think over the years, I believe, could be wrong, but I believe you'll start seeing some institutional investors actually build these capabilities within their institutional portfolio, because in reality, these managers should sort of be put into a larger portfolio to the extent they complement what's in that existing portfolio. So it should be a much more customized approach, and I think that's over the years, I think we'll see more and more folks gravitate to that type of risk management process.
The problem with I agree, we have tail risk managers too. The problem is that dedicated portfolio hedges, they have an opportunity cost associated with them. The expected internal rate of return of dedicated hedges over time is not very good. So in the short run, it's nice to have these tail risk protection strategies in there. But over the long run, especially for unleveraged portfolios, they're taking up space in your portfolio with a lower IRR expectation. So as Greg says, it's very difficult to calibrate them just right.
And I would just say, and David's right, I would say the issue is, and the way we do it is we figure out, and I would say a lot of hedge funds do this also at the lower level, is basically figure out how much you're willing to spend. So, again, I hate using this word insurance, but in a way, that's the way I think about it. How much am I willing to spend a year to get a certain level of protection in this portfolio based upon certain scenarios? If the equity markets are down 20% and credit spreads widen out by 300-400 basis points, I have a pretty good sense of what's going to happen in my portfolio. So how much am I willing to spend? Am I willing to spend 80 basis points a year, 100 basis points a year in order to protect against that move? And then sort of we reverse engineer how much we allocate. Today, the allocation to tail risk hedging in our portfolio amongst those managers is roughly 4%. There's some academic papers out there that sort of, it's funny, academic papers basically get you the same gut feeling, but they basically say between 5 and 7% on a well-diversified portfolio. But David makes a very good point. It's very tricky. The risk is you put too much in it, and equity markets rip up, and you don't participate. And then people ask you, well, why didn't you make the money? So you never make everyone happy. But I think it's an interesting thing to add to a portfolio, because really what you want to do, and I think the lesson learned is you do not want to, and institutional investors do not want to live through another 2008. And so you got to come up with ways to protect the institutional investor, either through your own product or offering something to them directly to implement in order to mitigate that 2008 loss. And I was with one of my managers probably a couple months ago, and this was before the most recent turmoil, and I said to him, what's your biggest fear? And he goes, my biggest fear is complacency, that everyone thinks they lived through 2008 and that's the worst it ever can be. Alan, I know is a historian of the markets, will tell you that 2008 clearly does not need to be the worst it ever is. So the fact that we can repeat 2008 in a much more severe way is frankly very much out there. And I think if you read the papers every morning, you wonder when it's actually going to happen. So I think it's important to have something in that portfolio to mitigate against that possibility.
Can I ask a question there? You mentioned kind of the way the asset universe looks now, mostly long short, but if you look back historically, you saw a lot more CTAs, a lot more global macro. But when I look at institutional portfolios, those tend to be underrepresented strategies because they're harder to model. And yet, those are the strategies that actually performed in 2008 because they tend to have shorter time horizons on the trades. And then there's the structural element going on now with, say, cyber CDS, where trades that in the past would have been on a bond futures contract have now moved into the CDS market, which introduces the whole counterparty risk of the ISDA agreement, on the voluntary restructuring question. My question is, are those strategies underrepresented in portfolios for where they should be, both looking historically on hedge funds' ability to deliver the promise? If so, why? Right? And then B, how would you structure things on a go-forward basis if you think there's merit to those strategies and classes?
Underrepresented, let me, everybody's got a different approach to the pure trend following CTA kind of thing. I mean, our approach has always been to have an allocation which we run through sort of a long-term model, and we look for people who can sort of add value to that, which you can do. And that number turns out to be, for just the CTAs, 4 to 5% for a fairly well-diversified portfolio. Now, September and October are going to give you examples of the worst possible environment for a CTA, because what a CTA will do, and CTA stands for Commodity Trading Advisor, but it's somebody who follows the idea is a pretty simple trend following system based on behavioral economics, which is as prices are changing, the actors in the market will start to move those prices, whether up or down, but it will take a while for that to be realized. So a CPA will do exactly what Warren Buffett says is the dumbest thing you can do. They'll buy when prices go up, and they'll sell when prices go down. But in 2008, when you get long trends, or when you get 1987 or so on, you definitely see it. There is a price, and the price is in periods of very sharp volatility. You pay for it. I think there are people with different points of view, and people don't do as much. So I think that's one.
Well, and can I ask you another question?
Yeah.
You highlighted kind of what happened the last 2 months to CTAs, but if CTAs actually had exposures to trades that in the past they would have, that now go off in CDS. Namely, in the past they would have been heavily short European sovereign debt, but that trade now is going on in a credit manager hedge fund. That is the proper way to kind of view these strategies, really, CTAs with credit hedge funds.
CTAs, the term commodity trading advisor gives you a clue as to where they would be in terms of CDS and so on. They're trading, generally speaking, for the large ones, in which a fund like yours or ours would invest in the most liquid strategies. So if you look at what they do, you'll find equity indices, not single stocks. You'll find bond futures in the United States and Germany. You won't find Italian bond futures in a CTA from that perspective. You'll find commodities, but only the most liquid commodities, crude oil, gold, and then you'll find currencies. So it hasn't moved there. The CDS question is an interesting one. As you point out, and getting back to sort of the risk management, that's a very tough issue. First, will you be allowed to collect if you're short? Either from a legal standpoint, what's going on in Greece, which is, it's a voluntary restructuring, will that hold? Or from a regulatory standpoint, will a fund that has a footprint in Europe be told to just close that down and go away? I would say the industries are split about 50-50 as far as that goes. Some people just won't do it, and others are comfortable buying that kind of default protection from that standpoint. Clearly, when they do it, they have to consider the counterparty risk. So the price of buying, of winning money is that you have to protect the money you won, and you have to have, ideally, you should have some credit protection on whoever's going to pay you and that price has increased. So that's really the answer. Structurally, you know, to be short credit default swaps at these kind of spread levels on investment grade, I would say it's pretty tough. Investment grade U.S., the European situation is probably above all of our pay grades at this point. You will legally, which in theory could pay that debt, you know, have material defaults when their bonds yield 7% or not. There's clearly a problem. Greece is pretty easy to see. But, you know, I would take it back to a couple of things. One, and sort of that CDS sort of illustrates the issue. I mean, if you're looking at a hedge fund, you know, within a hedge fund, risk management is really important. In do they know what they're doing? Is there any source of surprise, MF Global, for example, that could catch them out? Is there a mismatch between their books that could catch them out on liquidity, which you definitely saw in several big funds in 2008. They sort of drifted over into private equity, and all of a sudden the money couldn't come back and they couldn't trade, and you saw really huge disparities between the ability to capture the rebound in the market based on those decisions. And some of that was, I think, size, which is sort of an enemy at the individual hedge fund level. People got to 25 billion, and they were looking for trades that would make them money over a period of time. Sometimes that meant just big liquid stocks, so they realized it. You know, just to sort of amplify the great points that were made, I would say if you're looking at the individual hedge fund, you're trying to figure out what can go wrong. What's the surprise from that standpoint? And do they know what they're doing? I mean, really, is there glass on the windshield when they're driving forward, or they got masking tape over it in some form or fashion? At a fund of funds level, thinking about hedge funds is complicated because you've got their exposure. Where are they on the market? They're long equities to some degree. You've got the presence of options, which can be significant. And options clearly will create a payoff matrix, which will very much vary in terms of how much the market moves. If you're long options and nothing happens, you lose money. But it's important as to where those options were, and it takes a lot of skill. And then the hardest to sort of model from a portfolio perspective is the behavior of the manager. Who really risk manages? There are people who will do that. And real risk management in any of these big markets means you have to have the ability to wake up every morning and look at your positions again and not fall in love. And that means you're going to trade out of positions too often. You're going to sell stuff when it goes down so that you can reevaluate. And in order, therefore, to make the kind of alpha that you would expect, that manager will have to come up with more ideas. So you can almost, if you have somebody who's doing that, what you get is more valuable. But you got to make sure that behavior holds. And there's a subset of people who will do that. That's just who they are and sort of most valuable. So when we look at a portfolio, you have strategies like CTAs, to your point, which you expect to behave in big long-term moves. You have people who are structurally trading in advantaged instruments that are tough. So somebody whose predominant business is in treasury bonds or funds or those kind of things, that liquidity will flow to them from that perspective. You have people who are structurally sort of neutral and really mean it, that trade pairs in equities, so they're long Coca-Cola and short Pepsi, or that kind of thing. That's a pretty robust strategy. But then there are the people who will also risk management. Paul Jones, you know, will be long S&P futures or short S&P futures, and he'll give you a really good reason why he's going to be there, but don't expect to come back in 3 weeks and say, well, you told me you were long, and find that he hasn't changed his mind. You could easily have. So that's valuable, and so you get sort of diversified from that strategy. And so sorting people into those two piles is a really big deal, and then considering what's left over as a structural element to the point of doing tail hedging. And tail hedging is great, but it's a last resort, as everybody's pointed out. The best thing is to get rid of the exposure which is causing you to do the tail hedging if you got too much. And to be pretty cold-blooded about it, if you're gonna hedge it, then you better believe that you're gonna make more money, you know, and this is net of fees, right? When you do it at an overall portfolio level, you're gonna make more money on that long position or that short position than you are, than it's gonna cost you
Let me ask Sean. Sean has, at Lighthouse, they have a differentiated platform, I guess, from the other members on the panel here in terms of that risk management and tracking drift of any kind, whether it's what Alan was talking about or exposures or strategy drift, any kind of that kind of perspective, which we struggle with in a much delayed fashion at the fund level. So you have a separate account, kind of look through real-time, I guess, window to see that. So do you add anything to that?
Yeah, and I just want to take 1 minute to answer Alan's question a little bit as well. I think when we look at institutional and individual portfolios, the least underrepresented strategy is CTAs. Why is that? I don't think it should be. I think it's actually one of the most valuable strategies for a portfolio. Although with bias, that's our background, and that's how we started in the industry. But there's lots of different types of CTAs. Just like with other hedge fund strategies, there's short-term CTAs, there's long-term trend followers. Short-term CTAs have killed for the last 3 months. I think part of the problem is, Alan, the return streams are so different than what traditional assets look like. The strategies aren't easy to explain, and you can go through long dry spells when equities, bonds, other things are doing just fine, that people throw it out. Also, when you talk about futures trading, the first thing that pops in anyone's mind is leverage speculation. The CTA managers, they're not leverage speculators. I think they're very good at what they do. I think the return streams are highly differentiated. I think if you look at the last 30 years of CTA returns, they've matched the S&P 500. Volatility has been the same, and correlation and beta have been 0. So it doesn't mean that they're always going to protect portfolios when the markets are down. There's going to be different time periods, but by far, in our opinion, they are the least represented, and I think it's for structural and risk reasons and biases that I think people have just had against futures trading for a long period of time. On the risk management front, just very quickly, I think some of the lessons learned from 2008, one of the things that Bob mentioned at the beginning that was frustrating for all of us was just any type of gating or suspension activity. I think the first rule of risk management is if you can't get out of something, you can't risk manage it. If you can't control the asset, you can't risk management. And if you don't know what you own, you certainly can't risk manage it. So I think you need a structure where you're able to see what you own very clearly, where you have the asset control. As Michael just said with MF Global, you understand the counterparty risk that you're exposed to. And I think that's going to give you a fighting chance to do what you want with your portfolios. So as David mentioned, we have set up our own accounts with the underlying hedge funds so that we can see what they're doing, and we can aggregate it at a fund-to-funds level to help make hopefully more intelligent decisions. But even more importantly, ultimately, to be able to put it in the buckets and explain it better to our clients. So that they can make proper decisions on the risk-adjusted returns over time.
That's a question that amplifies on that. It's related to several comments here. That in order to be able to maybe shift monies into tail risk type of strategies, or reduce just this exposure to the problem areas as well, and to be opportunistic when a dislocation occurs, is all based on the underpinnings of liquidity. And part of the hedge fund promise, if you will, was this aspect of liquidity that funds would state that they had. And there was, I guess when I started doing this long ago, I used to consider hedge fund as a asset class, as a strategy, your typical long, short, or pairs trading with a market neutral type of manager. And private equity being a long-term lock-up, growth play with you put money in and 10 years later something comes out of it. And there was an epiphany one day when I realized that the market was no longer distinguishing between those two strategies. It was simply contractual fee structures and liquidity. But the underlying strategies, you had private equity managers trading all kinds of liquid distressed things, and you had hedge fund managers doing private equity and real estate. biggest disappointment of the hedge fund promise and biggest hindrance to adequate risk management, particularly in our way, was not being able to access liquidity that you had counted on as advertised. And the arbitrary, well, we said, here's the liquidity and the notice period and all that. Unless, of course, we decide there is no liquidity and everything's gated and all bets are off. So just ignore what I put in there. And that was traumatic, I think, and it really inhibited our ability to be a fleet of foot as we'd like to in times of that. Can you comment as to if we have another 2008? And I think Alan's credit, I hope he's wrong, but Alan talked a lot about what you learned by looking at the historical perspective and the Depression about, there was that 29 crash, and then there was that period of looked like we were out of it and it seems like about 2 or 3 years before the real unwind came on, and maybe we're sitting on that precipice again. What real structural changes have happened in the industry, at the underlying fund level, and as you've managed portfolios to prevent that kind of real arbitrary gating or, selling of the strategies that you could sell, not that you should sell? I mean, I saw some examples of, because there were liquid things in the portfolio, a manager might have had things like a classic basis trade where, you get the physical and the CDS and it's blown out, but if you hold it, it's converging and there's a lot of alpha there. But I got to blow it out right now because it's the only thing I can sell. And a lot of foregone alpha in that. I saw a trend for a while, some managers just finally saying, we're going to just cleave this fund in half and we're going to say this is the liquid part and this is something else. But can you give it a sense of the lessons learned there and structurally how the managers have changed and how you view allocating to certain managers or doing things that hopefully will allow for that part of the hedge fund promise to be there when we need it?
Well, I'll jump in first, and I'm sure everybody has thoughts. I think that the managers made significant changes in terms of their less liquid activity, so they do less of it. So they don't invest, at least in our universe. You can always find managers that don't fit this way. But managers are not doing private equity, private debt anymore, most managers. And the amount that they did have is running off. So if you look at their underlying liquidity, it's just better, first of all. And our monitoring procedures are also better. So we go in and look at their average daily trading volume of the securities they own, how long it would take them to get out, and 100%, and 50%, and 25%, and so forth. So their underlying books are more liquid. They have less side pocket type of activity. The terms of their funds are also much improved since 2008. So they have less ability to, in many cases, to gate and side pocket. But the key is really to understand the liquidity of their portfolio granularly versus the liquidity of the terms that they're offering, and make sure that you're in managers who can meet. So we look at the terms of the liquidity in the pitch book from the manager. It means nothing to us. I mean, that's an exaggeration. It does mean something. But when we go in and look at the actual portfolio that they have, that's where we measure the liquidity that we can gain. And that's not to say that you shouldn't have some budget in your portfolio for a little bit less liquid. There are some interesting opportunities there. But when a manager is supposed to be liquid, we need to make sure that they are. I think that we've come a long way in that regard.
I would just pick up on one of David's last points, which is, I think the investor actually, us and the institutional investor, needs to understand the liquidity as it relates to the strategy. So, Bob, you mentioned tail risk, for instance. In the tail risk managers, and again, it's relatively small, but even within those managers that we invest in, to your point, in order to invest in tail risk strategies, by definition, you're going to have to be somewhat tactical, right? There's no use in having the market go down 30%, your managers and tail risk go up 40%, and not being able to do anything about it, right? Because the whole point of it is to preserve capital, make money when the market goes down, and take some of that capital and reinvest it again alongside at a trough. Most of those guys are monthly liquidity because they understand that the idea is to be tactical. In fact, one of our tail risk managers decided in one of the more violent months this year, where he was up, significantly, he opened up in the middle of the month. He's like, I understand guys are going to want to reinvest some of this capital on the long side now, so I'm going to open up in the middle of the month if you want to redeem. But I think it's very important, David's point, which is you have to sort of look at the underlying liquidity relative to the strategy. One of the things we did post the credit crisis is we created a new fund which had worse liquidity terms because we recognized the fact that everyone was so focused on investing with managers with the best liquidity that there's a whole bunch of opportunities out there that no one was able to focus on because managers were so concerned about the liquidity they weren't putting money out for longer periods of time. So I agree with David, when you got the whole world focused on when they can get their money out, it may be wise to take some portion of your money that the fund can afford to tie up and invest longer, because there, we believe, is a big arbitrage opportunity, because post-2008, when you walk into an investment meeting, the first question people ask you is, when can I get my money out? Well, that's forced all the underlying managers to think shorter term, which means very few guys now are thinking longer term, which being sort of a little bit of a contrarian, that's where we want to focus now. But I think it's very much to David's point as well. I think managers have done a much better job of understanding how to match up what they're investing in with the terms they're offering, and as well, the terms have become much more difficult. Having said all that, you'll still find that sort of boilerplate language in most of these agreements that say, in the event of a disaster, we can do whatever we want. Which, it's still a risk out there, but I think everyone in the industry has done a much better job of focusing on these issues.
I mean, it's really sort of an interesting question. I mean, there were lots of things that got in the way of liquidity, some of which, from my standpoint and our standpoint, made sense. I mean, if you were in Lehman, it was a big fund, and so there was a piece of your fund that might have been locked up. That was rarely material. I think at the peak for us, that was like 1 basis points of the fund. So that's not the issue we're talking about. Clearly, there were people who responded with size, drifting into private equity. So Chrysler ends up all over the place and so on. And that didn't make a lot of sense in terms of what people did. It was very punishing for us. I mean, we paid people out the money, and we did redeem from some people who offered liquidity and clearly made a lot of money back the next year, and other managers just said we're sitting on the money. And then they'd sort of say in September of 2009, look how well we did. We made back 40%. Yeah, I said, the guy we redeemed from made 90, so thanks. I think everybody's taking an approach, and I'm sure there's a lot here. I can tell you that we don't have money with managers who chose to gate for reasons that made any sense, period, and will not have money with those managers, and I think that's an appropriate response. That's a broken promise, and it was foolish. The issue with liquidity, though, is one of the scary parts of the market in the sort of 2007, 2008 period, is people were offering more liquidity than they could deliver, which is what everybody said. And we were, and you also had institutions coming along saying, we don't want liquidity. The endowments were in there saying, lock the money up for 5 years. In a long-short equity strategy doesn't make any sense. So the point that's being made, matching liquidity to the market is really key. And you don't pay you shouldn't provide somebody a lockup or a mechanism to tie up your money when they're investing in something that doesn't need it. Long, short U.S. equity, you should be able to get out with a bit of notice and with real stress, not with the last 30 days trading, but with what will happen to trading volumes in your small cap stocks or whatever. Commodity trading advisors are classic examples of this because they're in futures, and the futures market is liquid. So when people really needed cash, they took it off, and that might have been a good idea, but there's a tendency to change the portfolio. So liquidity thinking about liquidity in sort of steps is really key. And we do a lot of stuff towards that end. I'm sure everybody else does here, in creating vehicles that match what we think is an appropriate way to get in and out of markets. That may look like somebody's hedge fund, but they'll run an account where we can control it, and we're not at the whims of other people who are next before, the European fund of funds were a big problem. They were all offering monthly or quarterly liquidity, and then they just put the money somewhere without even thinking about it, and ran stuff all over the place.
I would just say, Michael's point is so dead on. I mean, the reality is, I remember in '07, I'm sure David's experience, I remember in '07, going in, competing for business, losing business, and you call up after and say, well, why did we lose? And the guy would say, your liquidity wasn't as good as everyone else's. I'm like, what do you mean? And so other fund of funds were, we were at that time, and still are 1 year sort of soft lock in the regular fund. And guys were monthly liquidity. And I just said to him, and I would go back to my office, I say to my CFO, how in the world are they doing that? And she'd look at me and she's like, I don't know. And we would lose business after business. And now I know, as Michael's point is right, now I know it wasn't real. They put it in their documents, they say monthly liquidity, but when push came to shove, they couldn't get it for you. So we lost a lot of business in '07 because we had the worst liquidity. So I started going into meetings and saying, I want to let you know right up front, I have the worst liquidity. But this is why I think we have the worst liquidity. Hopefully, if things go bad, and we were never not able to meet a single redemption, ever, timely. But, for a while there in '07, the business got a little crazy. At the hedge fund level, at the fund level, everyone got very greedy to get as much money as possible, and they were offering, guys were competing on terms. The biggest term to compete upon was liquidity, frankly, because no one wanted to lower their fees, so they would compete on liquidity to differentiate themselves. And guys were giving monthly liquidity. It was like unbelievable how they were doing it, but now we all know they weren't doing it. The other thing I want to say about Michael's point is so true. The industry has policed itself, right? So we're not going to give money to hedge funds that locked up, right? Unless it's sort of like the Lehman scenario. But the long-short equity guy who locked up because he was a pig, he just didn't want to give the money back, those guys will never get money. Most of those guys don't exist anymore. So I think the industry's done a reasonably good job of sort of, basically policing itself and saying, okay, if you didn't live up to your promise, you're gone. And there's a lot less players in this industry than there were in 2007.
One of the, just fast forward to today, one of the things we're worried about on liquidity. So everybody talks about, and we agree that with the prop desks mostly gone and the dealers not that active, this is good for hedge funds because they've been the main competitors for the last 20 years. We agree with that. The negative of that is the dealers don't have a lot of inventory today. If you're invested in structured credit and distress today and you need to sell, it's not going to be that easy relative to some of the old days because the dealers just are not bidding. So if you're going to be in that type of strategy, you need to have the proper runway for liquidity. And so that's just kind of a current concern.
David, what is the current regulatory environment for hedge funds and how will that affect returns going forward as well as investment protection? I mean, we've obviously had some changes.
Well, we'll know more in a couple months. Dodd-Frank is not even really written. In general, we're not overly concerned with regulations. The investor protection type of regulations, where accreditation standards and things of that nature, we like. We embrace and support. The registration of hedge funds with the SEC and other agencies, we embrace and support that too. The only areas where we would have some concern is when they start limiting some of the strategies like short selling bans. Those are not as useful in fact, but we're not overly worried about that. The US government, the UK government have acknowledged that the short selling bans in 2008 were not effective in achieving their goals. And we don't, even though in Europe there is a limited ban, it's much more limited today than it was in 2008, so we're not overly concerned. The CDS issue is a real one. The problem with the CDS market is that because the European politicians tried to work a voluntary default with Greece, and so the CDS wouldn't pay off, that's actually not been helpful for countries like Italy and Spain, whose yields are now going up because people are now shorting the cash sovereign bonds because they're worried that if they buy the CDS, they're not going to get paid off. So now they're shorting the bonds and the yields are going up, so that they hurt themselves. So a lot of the regulation has unintended consequences. But the Volcker rule, we'll see how that gets written. The Volcker rule has always been thought of as being good for hedge funds because it'll reduce the competition. Still think that's the case, but now they're kind of softening that. So Overall, not overly concerned, but watching.
I would just add, besides structured credit, which is always sort of an interesting market, corporate credit is, I would guess, the market that is going to take the biggest change from the dealers removing capital. It's always been a market that someone, that means high yield bonds, trading in U.S. debt and European debt. The cutbacks are real. I mean, there's no question. The desks are being disassembled. The risk capital is out. It's been a weird couple of years in the sense that you read these headlines about where they put money. You can see people who wouldn't allocate risk behind a treasury desk, and and there's risk in treasuries and so on. They wouldn't take it. They would go buy subprime mortgages without a clear place to put them on the other side. Now, subprime mortgages make sense at the right price, but the dealers have taken a big hit on them. But the idea of getting out of markets, the dealers were important counterparties. If you paid the price, they would step up. And it's not reasonable to think that they're going to be there at the same time. So people will have to manage their own liquidity. And that means if they want to go into it, they'll have to create lockup structures that give them time. That doesn't mean they have to hold on to money for years, but they need a runway out. I think you're going to see, I think to David's point, you're going to see more profits in the sense that people who actually hold it and know how to deal with markets, will get something for that. They'll be able to, they'll basically be the desk from that standpoint. But the price is, you're committed and you're going to take more punishment longer term. So it's a really big deal. And as you sort of read the newspapers over the last couple of weeks, and as you read them over the next month, you're going to see serious levels of layoffs and permanent reductions of capital in that area, partly in response to regulation and partly in response to errors, but it's there.
Do you think that as a result of the regulations that you're talking about in terms of the dealers facilitating trade versus proprietary trade and difficulty in trying to differentiate between, will there be a greater move to agency trading as opposed to principal trading? I mean, how does that all play out?
I was a proprietary trader, and I was a facilitating trader from that perspective. And you cannot, if our markets are going to move strictly on an agency basis, it's going to be very tough. There are things you can trade that way, but the problem is that there's an issue of when everybody's present. If you start, if you're just trying to line up buyers and sellers, then you got to have everybody in the room at the same time. So it's a Friday afternoon, and people went on vacation. In the summertime, people went on vacation, and I've dealt with this. You can get a great opportunity. One of the most talented guys I said, always says, I never take time off between Christmas and New Year's, ever. I'm not at my desk every day, because somebody will call. So he's talking about employing risk capital. So a pure agency model is very tough, and it requires transparency in that market. So in the futures market, where you spend all this time creating standardized products, so you've only got a limited number of bonds you can trade in the U.S. Treasury market, for example. Okay, that's fine. Everything, it's a standard thing, so everybody comes together on liquidity. Lots of markets that are huge markets are not represented in the futures market because they're more diversified. Credit default swaps are an example. That's a market that should be in the futures market, and I think we will all pretty strongly, but it's not, and that's. But if it is, it'll be a different market because you'll have a 5-year product. Everybody's got to come together, and maybe they want only 4-year protection or 6-year protection. They'll just have to deal with that later. So I don't think it works very well. Is the short answer. You need an intermediation, but the big shift I've seen is that the initial reaction was, well, our flow-based trading will become a little more proprietary or whatever, and now it's much more the other way. It's going like, no, we're going to adhere to these rules very carefully.
I want to shift gears to the 20 minutes or so that we have remaining, just some kind of forward-looking expectations and where opportunities are on the horizon for us. But let me just make sure that any commissioners, anybody have any other questions? for our panelists. So Sean, we'll start with you. Starting with a clean slate for 2012. Either the incremental new manager or the first manager in a portfolio for and distributor strategy. And where is that opportunity in your mind? And similarly, if we were going to cut something for 2012, what would it be?
Start with the opportunity first. I think there's a big opportunity again that's opened up in credit. I think credit spreads widen significantly again in the summer months, and I think for opportunistic long-short credit managers, there's a number of situations out there that are very interesting. There's still Lehman bonds to be resolved. We've got MF Global bonds that need to be resolved as well. And there's just been less capital chasing some of these opportunities. I think with Europe, it's still much a wait-and-see approach. If there is a flood of paper that comes available over there, then that will become a real opportunity. The flip side to credit is if for some reason Europe falls apart and there's disintegration, you're higher up in the capital structure. I think these bonds will pay off if the managers have done their work over time. You might take some mark-to-market pain, but we really like the fact that credit has widened out quite a bit here over the last several months, and there's been some very interesting situations that have unfolded there. So I would probably pick that for 2012 on the opportunity side.
The other side?
On the negative side, things that we're staying away from. I mean, the big things for us, have always been the same. And we tend to try and run very low beta portfolios, so we are not interested in strategies that have a lot of net long exposure. So we're not big fans of investing with long-short equity managers that are 80% net long. Never have been, so we've avoided that. But these last few months, I would say, have opened up more opportunities looking ahead than things have shut down. In the summer, we were much less excited about credit, about convertible bonds, about merger arbitrage, about stat arb, a number of strategies. But things have opened up again. So I can't point to one thing just to say to avoid, but just taking general beta risk is something that we want to avoid, and we want to stay very stock specific again, in case something really goes wrong with stock, or credit specific, in case something goes wrong with Europe.
Well, I agree with John's comments. I think our favorite strategy for 2012 would be structured credit, and in particular RMBS, residential mortgage-backed securities. And we would do it in a way without leverage, where you can get, literally today in the U.S., these are U.S. securities, 9 to 12% current cash yields on an unleveraged basis. Those are loss adjusted, so with real assumptions built in. For example, home prices decline another 10%, 75% of these borrowers default. You sell the houses for 30 cents on the dollar after foreclosure. These types of tough assumptions are already built into your 9 to 12. And if you get a little bit lucky and home prices don't fall by 10, 15%, you're really looking at mid to high teens IRRs with a lot of that cash yield. As I said, 10 plus cash yield. And you've got some options built in there. These are floating rate instruments, so you've got a bit of a natural hedge against currency debasement. So as the Fed keeps printing money and inflation is expected to go up in future years, you get some higher yield there. You've got another option in terms of settlements. If there are these putbacks, this litigation settlements, you got another option there. So we like those a lot. You need to have a 2 to 3 year horizon on these things, because you can get mark-to-market losses on these. But if you have a 2 to 3 year runway, that would be our favorite trade for the coming year. And then on the negative side, long-biased European financials. Particularly on the equity side, not that there's not some decent debt plays, some of the tier 1 debt securities for European financials look pretty decent, actually. But especially the ones that don't have a lot of the PIGS exposure. But we would be trimming probably from the long biased equity securities in the future.
I have a comment. I agree with both Sean and David on the sort of traditional credit and also the structured credit. I think the structured credit is also interesting because, you know, we've made obviously a tremendous amount of money. I think everyone in this panel makes a tremendous amount of money in opportunities where you have sellers that are selling assets that are quality assets, but the sell out is stress. So the structured credit market, I was speaking to one of the managers, one of the large hedge fund managers, about 20% of their book in structured credit, and they gave us a statistic that there's about $2.3 trillion of structured credit paper that still needs to be offloaded by the banks as part of Basel III, as part of reducing and increasing their capital ratios. So we think there's going to be an interesting opportunity going forward in 2012 as these banks figure out what they need to sell and how much money they need to raise to buy some quality assets from some stressed sellers. So I agree with both those. I guess the thing I would add is we also have reduced exposure to long-short equity managers, so the traditional long-short equity managers. I think in general, the last 3 or 4 years, their numbers have been relatively disappointing. And what we've done with some of that capital, and here I'm a little different than I guess some of the guys on the panel, is we've actually taken some of that money and actually put it to more activist managers. We've had a lot of success over the years with activist managers who tend to be a little more long directional. They do have some hedging, but you know, we've gotten a lot of comfort investing with managers who come to situations with a game plan. Guys who are willing to interact either sort of cordially and patiently or at times aggressively with management teams to get things done. And as stress has rolled through the boardroom, management teams have become more willing to work with some of these activist managers. So in general, our activist managers have done significantly better than our long-short equity managers. And so there, we continue to reduce the long-short equity managers in the portfolio in favor of taking some of that money and putting it more towards the activist managers in the portfolio.
I don't disagree with any of this, but I think in terms of the general approach, I mean, first, and I'm sure everybody said the same thing, you know, the first thing is there's sort of the top-down, where's the opportunity set, but there's also the bottom-up, where are the people who can still make money in this market and retain diversification. So what's in that bucket, and that's always an emphasis and so on. But within the realm of places where we would, you know, so where we take money away from broadly as a category, long-short equity, because it isn't clear, and this is a, you know, it's a big move in dollar terms, and it's not a small move in terms of percentage of portfolio, but it looks much more like you would do from an institutional point, where a 5% move is sort of a big deal, and 10% move is a really big deal, and that's sort of the scale of what we're talking about. In diversified funds, I mean, we manage other funds, but the other area is big multi-strats. I mean, that's an area we don't have a lot of exposure to. We have some, but that's been shrinking for a long time, and that's going to continue to shrink. It's a very challenging opportunity set for them. There are people who can navigate this, but it's tough. They're making the same kind of choices and so on, and you can't allocate too much to one strategy. We're all, you know, the idea of structured credit is terrific. You can hold it for 2 years. It goes back to that promise. You can sell it. There is real liquidity, and it won't be improved by Wall Street cutting back, but if you do, it'll cost you some money. That's different from some other asset classes where you probably just can't get out in a really tough period. But you can't put 50% of the portfolio in there. And our big question, quite frankly, in that area is we see it as really attractive. We see it as really attractive for you. You know, we're negotiating with people in terms of setting up vehicles to run it where we're not paying 2 and 20, where some part of that carry, you know, there's a hurdle rate from that perspective, which is appropriate. These are assets that you do need to be smart. But not, you know, the 10 to 12%, or if you want to do broadly 8 to 12% is available. But if you just want to go out and hoover up what's in the market, you know, I was a mortgage trader. You know, it's always a market that has taken advantage of new entrants and continues to do so. So you need the skill and you want to pay for it, and it takes quite a good sized staff. But it isn't, it's sort of one of those things that's on the edge of what hedge funds do from that perspective. And in corporate credit, if you're not a big company here, if you need to borrow money for a couple of years, it can be really tough. I mean, you're looking at 9 or 10% kind of yields with real seniority, where you're not reading the newspaper as to whether Mario Monti or Berlusconi is in charge or anything else. These are companies with cash flows that make sense. But it's not Coca-Cola or General Electric from that standpoint, but they're real businesses, and they're not tiny businesses. So that's sort of what's attractive from that standpoint. We're also pretty, although it's a percentage and limited, commodities is an area where we already have that exposure, I would say, as much as anything else, but are still focused because the global balance sheets are pretty tight. So we take that data along with some of the activists and managers, something to look at.
So we got 5 minutes, guys, so real short answers here. But interested in y'all's perspective as significant allocators of capital here on the subjective assessment of your managers. Personality characteristic or short list of characteristics that you look for in your managers in terms of what supports their ability to maintain the edge, as I think Greg put it earlier, their edge in the market. Sean, you want to start with that?
Sure, I think the most important thing, to us is risk management. Risk management comes in a couple different forms. It's being able to select securities that represent value, and then also the ability to survive tough times, make decisions, take losses when you're wrong, when your assumptions are wrong. But those are the types of managers that we think can produce returns over time and are the most stable over time. So I think risk management is often overlooked as an offensive weapon as well.
I heard the term being intellectually honest with respect to the risk management perspective when the manager actually looks at that, and I thought that was an interesting term.
Yeah, you got to be able to take a loss.
Well, I would say that the characteristics I think that are most important are being an independent thinker, having alignment, the portfolio manager having alignment with his or her investors, the hunger, the drive, the motivation, tight risk management, tight stop losses, as Sean said. But if you look over time at the most successful investors, I think that the common characteristic is real conviction and risk tolerance. Actually, the willingness to be a contrarian, take big positions, put your money where your mouth is, and just have a lot of conviction. I think it's probably one of the most important traits.
I agree with all that. I guess I would say, first and foremost, you want to do business with people who you have unimpeachable integrity. I think that's something you want to get a handle on, and I think the way you do that is you do as much work on the person as possible. So we spend a fair amount of time on that. I think at the end of the day, it's about integrity. I think obviously also you want to get some handle on ultimately what all business is about, which I think is some sense of judgment. At the end of the day, people are making decisions every day. I think relative to hedge fund managers in general, I find the guys that, particularly in difficult times, protect you the most are the ones who are the most paranoid, they're most risk averse. Not guys you may want to have a drink with, but guys who, when you wake up or in the morning and it's sort of sunny and you call them, you go, how's your day? Then they're looking at the same sky as you, they go, well, I think it may rain. And you're like, okay, that's why I have money with this guy, because he's always worried about the downside. So in general, the guys who have preserved capital the most sort of have it in their personality, to David's question, but sort of always looking at things slightly different than most, always trying to figure out what's the worst thing that can happen. But I think this is a business ultimately about, like most businesses, about judgment and integrity, and you have to spend a lot of time before investing $1 and making sure that that's the kind of firms and that's the kind of people you're dealing with.
Yeah, I think those are all great points. I would add, maybe a little more controversially, we would generally look for an absence of work-life balance. If you're not going to, you're competing at the top here. You're competing with the best. When Goldman Sachs calls you to sell something, your immediate reaction, paranoia was mentioned, your immediate reaction is like, I got two choices here. One, do I short it? Okay, that'd be step one. Can you afford it? You know, or two, what do I do? You know, particularly what's my close friend who calls me. So, and that sort of intellectual honesty, I think, is also, you know, are you willing to turn the Rubik's Cube? Are you willing to keep searching for that answer? Why am I so lucky? You know, you gotta have conviction, but you gotta make sure that you haven't missed something. And the people who do that best never rest. And I've worked with some before I started in this business and some, and they're impossible. You know, it's like, it's 6:30 a.m. What about this? It's over. Well, I haven't quite figured that out. You know, let's keep looking. And that is something you find. And then the question is, over what size can somebody project that? You know, because there are people who are good individually. You know, you have some folks who can work with others and not drive them crazy, and you have other folks who are just sole operators, and how does that fit into a structure?
Yeah, a question.
Go ahead.
Aside from the mental and psychological profile that you, how important, or what importance do you attach to having having some skin in the game alongside?
Non-negotiable, and it should be ideally all of his money, or her money, or most of his or her money, and pretty much don't do it any other way.
So it's got to be more than the total amount.
It's got to be, if they're not feeling pain, when you're feeling pain, then it's crazy.
Yeah, I'd be shocked if any of us invest with guys that don't have all that money, you know, basically all their, for the most part, all that money in the investments. I mean, I have all my money in our investments. I mean, it's sort of be unheard of to do it any other way.
I mean, there are people who become so wealthy that there are other things, you know, Stevie Cohen's art collection, but he's still got a lot of money in the fund and so on, you know, Tepper's business school. But I mean, that happens. But I look at the materiality of the person. For the right person, having $2 million in the fund, you know, with a mortgage on their house is, you know, it's more important than somebody else who's worth, you know, $500 million throwing in $20 million.
And you've done that as well. I know with us, like for instance, in the strategic partnership, you required us to put up our own money in the strategic partnership as well. You wouldn't want to do it any other way, frankly.
So, yeah, I have a question thinking about the opportunity set going forward, and when we talked about liquidity earlier, you know, my point on tail risk was having liquidity elsewhere that you can access to load into those things, not how liquid they are. And you know, we attempt to run this, you know, looks much more like an endowment model, where you know we've got a very good view on what we need in liquidity in the short term. We have benefit payments that are due, you know, 2 weeks from now that have to be in a bank, and we have people who are contributing that are 22 years old that we don't need to pay for 50 years. So we attempt to capture the liquidity premium everywhere we can. But what that does then is it really narrows down the pressure on the things that you are assuming are going to be liquid to indeed be liquid. But when we look at the opportunity sets out here today, when you go through the spectrum of things like, you know, CMBS or CLOs or CDOs or other structured credits, things that managers might buy. Greg, you mentioned you know, the banking pressures and Basel III and the like. Yeah, at what point do things maybe become inappropriate for a hedge fund, and maybe you should be looking at some other kind of private market structure? And specifically, I'm thinking about the spectrum as you go on out to maybe senior secured bank loans, or then whole loans, which obviously is, you know, a ton of what the banks are sitting on. Is that things that, you know, can be capitalized on by hedge funds, or at what point does it become, it's really a different strategy? It's obviously a great investment opportunity, but you should consider and expect that you're going to have to access that through a completely different view.
Yeah, no, I think that's a good question. I think it comes down to sort of your basic question about liquidity. I mean, it's all about, you know, there's some of those things you mentioned, some of those investments we think are very attractive investment opportunities, but it's about whether or not it's going to be able to provide the liquidity the underlying investors need. So that's why, as I was saying earlier, post-2008, we set up a vehicle which was a much longer lockup, because our managers were bringing to us ideas that were within those kinds of securities you mentioned, but it was clear to us that a traditional fund-to-fund, or even a traditional hedge fund, could not access this. So what you've seen hedge fund managers do in order to take advantage of those opportunities is to create longer lockup vehicles. I mean, it's sort of like a little bit of the opposite of what we were saying earlier. Yes, there's a lot of managers that said, okay, we're going to invest in things that are much more liquid and we're going to adjust our terms to provide more liquidity. At the same time, there was the other side of the spectrum where guys said, look, there are also a lot of opportunities out there that we have an expertise in, that we can bring our expertise to bear, but there's no way we can do it in a vehicle that's, 1 year or 2 years. So you have a bunch of managers that actually set up vehicles that were 3 or 4 year locks. But a traditional fund-to-fund couldn't do it, so in our case, we went out and we raised new money that allowed us to draw down capital when we saw the opportunity in longer lockups. So it's frankly a balance, but I think all the areas you mentioned may pose to be phenomenal opportunities. You just can't do it often in your sort of traditional fund-to-fund approach, or traditional hedge fund approach.
Right. But it seems to me what maybe is part of the trend, and I don't know if it's permanent, but I mentioned before the epiphany of, I realized that a hedge fund and a private equity vehicle is just different contractual terms, not different asset strategies. But we really had this, monthly or quarterly liquidity or 10-year lockup plus 2-year extension. And, this is really bifurcated structure. So what you're mentioning is now more of a continuum that's being built in. Is that something that, may be a really a secular change in this type of market, or if we're sitting here 5 years from now, 10 years from now, that maybe there's a spectrum of lots, and we're not even differentiating anymore really between hedge funds and private markets. We're just differentiating between tenor and lockup.
Well, no, there's also the development of BDCs and business model companies that are doing a lot of that lending to middle market companies. The loans are liquid, the securities are liquid, and at times they trade at huge discounts to book value, and you can go in and access those strategies and still have daily liquidity to the market. They're not the most liquid stocks, but they're attacking those strategies. You can invest with Chimera that's going whole in this. So I think there's also an advent of bringing market liquidity to illiquid asset classes. The problem is the time you may need to tap that liquidity is when everyone else does, and things are traded at 0.5 a book. But if you can reverse that equation and buy those things at 0.5 a book without any lockup, I think that's a whole run.
And you kind of in your mind treat it as really not my first choice of liquidity, but hoping to sell it when it's
right. But if you get it, but if you're going to buy
it
it
at 0.5, you can pull it out.
you're going to buy it into a private partnership at book value, and you can get it in the public markets at 0.5 a book value.
Yeah.
But you have a luxury that some people don't have. I mean, we had longer lockup money, and it turned out to be the best performing. It's like sort of 3-year lockup. But there were things in there that didn't need to be locked up for 3 years that we thought were just good opportunities, and things that were absolutely locked up for 3 years, and things that were managers locking up for 3 years whether they needed to or not. So that's all well, but it's hard as a cohort, as you're structuring your portfolio. I think you can think about what am I paid extra. There's a very concrete payment for that extra yield, and the markets really differ in terms of what's your cash flow. So if you invest in commercial mortgages at this point, you have to expect that even the stuff that hasn't matured will delay. And where's the money going to come from to pay it back? These are senior credits, but at some point, the cash, there's a missing number that, you'll pay whether it's $500 billion or $1 trillion. But somewhere, money's got to come into that market, or you're not getting your money back. So that, you might get rewarded for. You might own the real estate and sell it and make a great profit, but as you think about the liquidity, if you touch that tar baby, you got to figure you're willing to fight all the way through. Some of the other stuff, you're going to get out in a couple of years as a function of either the sort of underlying cash flow or 4 years and so on. So I think that's a good.
So looking about, which I think is I don't know if it's a subtle point but I assume it's something that you all realize what you've done, which is, I think what you've done by moving to these strategic partnerships is actually sort of the new way of doing things. Now, I think you're early and your first movers in this, but if you think about it, just take the relationship you have with us. So before, you were in our commingled fund, we agreed upon, basically gave you the liquidity that all of our investors got. Now, over time, as we get the strategic partnership up and running and we fund more specific investments, you all, with us, are going to choose what the liquidity requirements are for each particular investment opportunity. So you're no longer, to Michael's point, you're no longer gonna just take this sort of blanket plain vanilla liquidity. You're gonna say, okay, if you guys are gonna do this, it's like, you know, structured credit, and you're gonna give me this return, then I'm willing to give you this amount of liquidity. And you're able to structure your liquidity based upon what the returns you're assuming and the strategies. And you're leveraging off, you know, frankly, the relationships of the four firms here that is vastly different. I want to make this point before, which is vastly different than a traditional public fund that goes direct. The traditional public fund that goes direct basically can invest, for the most part, in managers we invest in, but they don't get anything else. Here, what you've done, which is actually, when you think about it, pretty damn creative and innovative, is, I'm not just blowing smoke here, but you basically have taken four very large, him the largest fund in the world, him sort of maybe the second, I don't know, I'm a puny guy, but you've leveraged off these relationships to now customize investment opportunities that are best ideas, best breeds, and you're able to negotiate terms and liquidities that are specific for those mandates. The guy who goes direct can't do that. This is sort of a very unusual thing I think you're in the midst of building out, and frankly, I think it's the right way to do it. It's much more customized, it's much more targeted from liquidity, fees, terms, and strategies.
So just one last comment. I agree with all of that.
That you're bigger than.
Well, but none of us. One nuance of your question, Bob, that none of us answered, I think, was the convergence nuance, which is, I think that over time the convergence between private equities, hedge funds, et cetera, is more in the companies. I think you'll see private equity firms have hedge funds, mutual fund firms have hedge funds have mutual funds. There will be a lot of convergence at the company level. I don't think from a product level it will all blend. So we look at it as kind of maybe three buckets in hedge fund land, you know, monthly, quarterly type of strategies, some long-short equity, macro commodities, and some relative value. Maybe the annual or 1 to 2 years, which is maybe the long bias credit or long short credit, and then maybe the 2 to 3 or 2 to 4 years, which is the structured credit, some distressed, process-driven, regulatory capital trades, things of that nature. I think that's pretty much it. Then when you start going above that, you get into private equity land, and I don't really see that converging down into the other three credits. It's just not my view.
I just add one thing, that the private equity, and obviously, you know, from my firm standpoint, you have both. The private equity capital is really different from the hedge fund capital. There was a period of time briefly when it was not hard to raise that money. It's hard to raise. It takes time and so on. So when the person uses it and they're getting a portion of the performance and so on, they are not going to make investments in general based on IRR. They're going to look more to multiple of capital over a period of time. So a 20% IRR, you know, for 6 months is really of no interest. Looking at 10 points, the capital costs more for them. So that gets to sort of the risk management question and so on. They're not built to risk manage. It's not that the investments aren't good, but the ideal investment there is somewhere you put your money and it stays for 5 years and you get 2.5 times or whatever the multiple back from that standpoint. If somebody threw in front of you a $20 bill and said all you have to do is pick it up, the answer is no. I'm waiting for the $1,000 bill. And so hedge funds, you know, are IRR-driven vehicles. They're going to look to. The answer is they should pick up the 20 and hope that tomorrow there will be another $20 bill.
We're out of time unless anyone has anything. No? Thank you all very much.
5 minutes. We'll reconvene 5.
I know if I don't.
No, but we will find it with them.
Are you like that level of gentleman? Like you just open it.
Come on with the theme real quick. He's on me. I've been doing this too damn long. Which one? The latest one you sent?
I made that decision. Comfort. Paramount importance.
Don't touch that.
That happened to Jeff.
Yeah, what a sentence.
Great, great. Good, nice seeing you. Okay.
Yeah, that's right now.
Oh, Nicole, I asked them about your pineapple cake this morning, and she said, because they were making something. I said, she said, no, we're not making that. I said, well, what was asking about? She said, I said, no, don't worry about it. This is my favorite cake. She said, we need to put that back. Oh, you know, I ate yesterday. Yes, I love that cake.
Somebody told me I should try some lemonade with some cheese. Is that good?
Oh, yeah.
Very good.
I noticed the theme, by the way.
Not only was that the second time I got lost, but I had to do other things at one point. Because there was a leak in the bathroom, water pouring down in the light fixture. Your sink was falling, I don't want to be in there. Adventures and
Yes, oh, yeah.
These 5 minutes turned into 20. I know, I think I'm feeling every single time the weather changes fierce like that, they'll just water. Like, that's no fun. I can't the freaking
You're gonna lose me on the third.
Yeah, that's why I want to get started. Ready? All right. We'll reconvene up.
Freezing out there.
went outside sniffling everywhere.
Yeah, where'd you go?
Trying not to go. I mean, some sanitizer.
All right, so we'll pick back up. We're going to pick up the items that were carried over from yesterday. There were 3 items that we carried over from yesterday's minutes. executive compensation because of the short size of the minutes and report of the audit committee. As it stands on the minutes, there was a point of order on which I am asked to rule. My ruling is that on the point of order that it will not be recognized. The rationale for that being that later in that same meeting, we were all present. For points of the meeting, certain individuals were out. The other item is sort of the purpose behind Robert's rules. While procedurally the item discussed and referenced in the minutes was not formally on the agenda, the point of Robert's rules is for the body to be able to, in a logical way, get to the consensus will of the body. That being the case, the issues that are alluded to in the minutes, if they were removed, would revert back to a prior action of it. But given that it took us 3 votes to get to those items, I feel like that's sufficiently expressed the will of the commission. So therefore, my ruling on it is that that point of order will not be recognized. Now, that said, my understanding is, according to Robert's rules, that ruling can be challenged. That would require a second, in which case it would go to the full vote of the commission.
That ruling can be challenged. Out of deference to the chairman and my respect for your impartiality, I'm not going to challenge it. What I will do instead is move that we repeal, if you look at page 4 of the minutes of the September 15 meeting, those are motions and set forth in indented blocks. And I move that we hereby repeal the action described in that motion. If I get a second, then I have some remarks.
What page is that?
It's on page 6 in your book. Red 6. It's page 4 of the minutes.
On here, 6, I believe.
There's a red 6 in the upper right hand corner. Blue 4 in the left hand.
Okay, so you're making a motion that the part in bold
be repealed and the date June 30, 2011 be replaced as was originally intended.
All right. Let's see, let me think through that one, because do we need to get well, first that would need a second, if that's going to come up. So we have a second. Discussion.
If I might, Mr. Chairman, one of the reasons I raised the point of order is I didn't feel that I was given a fair and full opportunity, or Travis was given a full and fair opportunity to participate in that decision. I felt then, as I feel now, that I have some worthwhile and important things to say. Sometimes when I say things, other people are convinced about, sometimes not. I want to go back to, at this point, I mainly want to go back to give some background, and then I'll return to some foreground. Let me give some background. At the very beginning of that meeting, when Mr. Loftus made his objection, he said, somehow it got to be June 30th, referring to the effective date of that bump. And he also said, and I'm quoting here, he said, Borden gave himself a raise.
Excuse
Well,
me,
let me-
where is this coming from? Is this in the minutes or is this?
And now this is from the tape transcript of the proceeding.
Excuse me, point of order. He has documents we don't have.
It's not a document. I listened to the proceedings.
All right, well then you have a tape we don't have. I asked for the tape yesterday. Legal counsel has provided to do that. I asked legal counsel yesterday and asked the chairman for this information. It is not equitable for you to have information we don't have.
It's at least as equitable for you to participate in a meeting at which you didn't want me present, Mr. Loftus.
It was Mr. Chairman, was that a called meeting with a required
Quorum?
quorum? Yes. I was there. Everybody else was there. You weren't there. It's not my responsibility.
I was late
Mr.
for a
Chairman.
medical reason, but I told the
Mr.
chairman and
Chairman.
the staff about
We had a call
And you
meeting.
violated the rules of order.
One at a time, please.
Mr. Chairman, we had a call meeting. The press was there. People were there from all over the state. It is not my responsibility that he was not there. You had told us early on that you would be leaving the meeting at some point. So we knew we were not going to have a full session. Why would we wait until the end of the meeting when we could have done it right now? There's nothing underhanded about that. There's no Robert's Rules of Order issue. There's no ethical issue at all. It is my
Do
responsibility
you
to
not
show
believe
up.
that now you said what I just said you said? Do you
I have no, until I see the record, I will not admit to any of that. That was an hour and 11-minute conversation.
If I can,
That was an hour and 11-minute
proposal
conversation.
here. The minutes to that meeting are not final. The tape does exist. It's certainly perfectly reasonable for everybody to have access to that tape and leave. And there's no reason we have to bring minutes of a meeting to conclusion today. It's perfectly within our purview to carry the meetings over until such time as, you know.
Well, as a matter of personal, that's fine, you take them up, but as a matter of personal privilege, I want to correct some misstatements, falsehoods, and deliberate deception that was made.
Mr. Chairman,
during that
I will
meeting.
not have him sit here and say that I make deliberate falsehoods if I don't have the information. I will not be ambushed here. This is a public meeting, and if he's going to be given the information by the council, legal counsel ahead of time, then I deserve it. This is an ambush, and I will put up with it. And I
Every
respect
member of
you,
this
and I will.
commission has access to the tapes of every one of this.
And legal counsel does too, but as I was told yesterday, it is our job as commission to serve the the chief executive officer. If you go to the executive council and council, you were here there. We were asked to.
Mr. Chairman, I have the floor. I
Yeah.
have not yielded the floor. I believe that I am quoting accurately when I say that Mr. said somehow it got to be June 30th. And he also said that Borden gave himself a raise. Now what I'd like to do is I'd like to recap the somehow during which that effective date got to be June 30th. Back at the June meeting in that room over there, Mr. Loftus called for an executive session to consider employee matters. We went into executive session. He brought up some matters not related to employees, and then he left to go to a photo op at Boeing, or for Boeing, I don't know where he was.
I've never been on the Boeing property in my life.
You said you had to go to a photo op that had to do with Boeing. I'm not sure what it was. At that point, I brought up the history.
Mr. Chairman, I need to leave.
Chairman, I have the floor, and I do not yield for a question. At that point, I brought up the history that this commission had of having, during the last year, having taken advantage of Bob Boyd. I said he had not gotten a raise since the year 2008, that we, by our ordinary procedures, that we should have considered a raise in December of 2010. But we didn't because we had other pressing matters at that time that were more important. That we could have and should have considered it again in April of 2011, but our budget was uncertain and the legislature was still dealing with that, and enacting a raise at that time would have created uncertainty. In June, the budget, when we met, the budget was 100% fine. And I said it was time to correct the injustice. Said we needed to give Mr. Borden a substantial raise, that it is our fiduciary duty to maintain our most valuable employee and to minimize the risk of him being hired out from under us. There was unanimous agreement that Bob had earned and deserved a significant raise. At that time, the commissioners accurately pointed out that Mr. Loftus was not present, and that as a courtesy to our fellow commissioners, we should not take action coming out of that executive session. I agreed with that, but I did remind the commissioners that employee incentive compensation is based on what one's salary is as of June the 30th. So as a courtesy to you, Mr. Loftus, we didn't take any action, but I said, I don't care if we have a special meeting next week, which there was time for, or whether we have a call telephone meeting. We need to make the raise effective as of June 30th. We all agreed that we could make it, we could consider it then if necessary, but we could always bring it up in July and make it effective June 30th, because routinely, if you make a raise, you can make it retroactive instead of prospective. I also said that we needed to have the figure correctly calculated as of June 30th so that Bob would get credit for the work he had done that entire year, which was extraordinary work. And that was the consensus of everybody as we left the executive session. Now, that's how it somehow got to be June 30th. When we came to the July 2011 meeting and we went into executive session, we discussed the same issues. Most of it was devoted to how much the compensation would be. But after we finished that discussion and got to the $485,000, Powers made his motion that it be, stated his intention to make a motion that it be June 30th. He said, and I recall saying this, I said, okay, so the new PIC will be effective next June, 2012. And the old current PIC system will be applied to Bob's new salary, right? And everybody said, yeah. And we came out of the meeting, Mr. Powers made exactly that motion, stated the June 30th date. Now that is the somehow that June 30th came about. Mr. Borden did not give himself a raise. He never asked me for a raise. He never suggested a figure. And I felt as my duty as a commissioner, my fiduciary duty to our biggest asset, which is our employees, is that we treat our employees fairly and honestly and adequately compensated. And when we decide to do something, we need to show our employees the same loyalty that they show us. And we don't show them that loyalty by haranguing them and bullying them and taking away things we promised to give them. I also heard, and I believe the record will support me.
He has been reading from executive sessions, which I have no notes of, I have no knowledge of, and as far as I know, there are no notes of. And in fact, this organization and every state organization have very specific legal qualifications, ramifications from divulging information from executive session, which he has been reading.
I'm not reading from any notes of any executive session. I'm reading notes of my own recollection. And speaking of respecting the rules for executive session, the very next morning in the Associated Press, you stated that Mr. Borden that we had given him this raise to keep him from being hired away from Virginia. That's a matter that was only addressed in executive session. I had never violated the rules of an executive session. In the regular session, let me return to the other misleading talking points that you spouted out. You said $71,000 is too much for one day's pay. Disregard the fact that's the wrong figure. That's deceptive to say that that was for one day's pay. It was for a year's pay.
Pursuant to Robert's rules.
I have to take the personal attack. When Mr. Chairman gave me the $70,000 number, not myself.
Mr. Chairman.
Yes, ma'am.
I said leave that aside.
Hang on a second, please.
Mr. Chairman,
Yes.
it would be proper for me to address you
Okay.
and answer any questions that you may have.
The question being?
Well, the question being, I have never in my life seen anybody summarily attack with the auspices of this board. The 5 members of this board are allowing this. He has already, to his own knowledge, read from 2 extensively from the notes of 2 executive sessions, which is prohibited by law. He has stated 3 or 4 things that are patently false already. And I don't think that I have to sit here and take this. I don't think it is right, and I don't know what legal action I will have afterwards. But legal counsel was here during that last meeting and approved everything. And now I have to sit here and listen to him say all this. It is not right, it is not equitable, and it is not honorable, Mr. Chairman. And I do not think there is any right for him to continue doing so, especially when the matter is not going to be brought before us today, because you've already said we all don't have the minutes.
The issue before the floor was there was a proposed amendment to the minutes which we would need to clear that from the floor. We're in the discussion related to those minutes. And Mr. Williams has the floor for discussion. That's where we are. To the question, I guess, would be, I can't personally report where the information's from, whether they're from.
He just said it.
Well, exactly. And so that's the information before the commission. So with that, I don't know how I phrase that as a proper question.
Mr. Chairman, it's my understanding under Robert's rules of order that Mr. Williams has the floor and he can voluntarily relinquish the floor, or I believe it's 2/3 of the body, they could essentially sit him down. But other than that, he has the floor, and then anyone afterwards may request the floor.
And so a point of order that he has deliberately divulged executive session information in an open forum. I'll make that to you as a point of order and object to it.
Not being able to determine that, I would say, you know.
Self-admitted. He just said he did. He just said he did. Those are his notes from 2 separate executive sessions. He just said he did. We have a tape. Let's play back the tape.
Mr.
Play back the tape.
Mr. Chairman, these are my recollections of the 2 executive sessions. And the reason I feel free to now recount my recollections from those executive sessions is Ms. Office misstated the content of one of those executive sessions when he said that he did not hear me say, okay, so the new PIC will be effective next June 2012 and the old current PIC system will be applied to Bob's new salary. Right. When you said that you didn't know anything about this and Bob Gordon was giving himself away, so that's a slanderous attack on Bob Gordon. And I'm going to defend this commission and the integrity of our procedures against your attempt to
Can we speak to the specifics of
Yeah, and
stuff?
the specific is, Mr. Chairman, you admitted, we don't have copies of the minutes, but you admitted that you didn't understand that either. From the chair, you said you did not understand that. So he has somehow imputed the fact that you and I didn't hear this. He's called me a liar and a slanderer. I don't think it is legal, Mr. Feinstein, and I don't want someone to rule me that I have to sit here and be called a liar and a slanderer.
I'm just recounting the facts.
And especially when I think he's in breach of state law.
Mr. Williams has the floor. And you can relinquish the floor, or the members can move to sitting there.
Or the chair.
At this point.
Well, it's my understanding.
And you also have the, I don't feel comfortable doing this in open session, but you do have a responsibility to maintain the floor.
And on there's an assertion that certain legal violations have occurred. My question would be, that's Mr. Reynolds' issue to address or not address, correct? Or would that extend further?
If you are asking for legal advice, then I would ask if you and the other members of the body want to return to client privilege in order for me to advise on open session.
I'm not going to do that. And ask for, well, we've got one motion on the floor. How do I get it so we can ask for a motion for executive session for the legal?
Discussion can be suspended and this motion, that motion can be entertained.
Okay. I'd like to suspend, like to ask for a motion that we go into executive session for purposes of receiving legal advice.
You need a second?
I need the motion. I can't make the motion from the chair. Do I have a second? Second. All in favor? Aye. Get it third and then. Jim, how do you vote on the? Meet in here. we'll now come back to the order. We'll pick up from departing to receive legal advice in executive session. Where we stand currently, there was a motion duly seconded for discussion related to amending the item in full from the minutes. And Mr. Williams had the floor.
Mr. Chairman, first, I apologize for losing my temper slightly. And for the lack of the floor that I had intended to make an uninterrupted statement, and when I got interrupted and off track, I realized that I lost my temper and probably overreacted. The reason I made that motion is not because I here I think it's particularly important what Mr. Board's bonus was, but I wanted to make these points, and I'm making much more briefly now. The point is, I want to correct any impression that there might be that the commission acted improperly in considering Mr. Board's salary and or bonus. That there was anything unconscionable that he did, or underhanded in what he did with respect to that bonus, or that there had been any backdoor effort to address the bonus compensation issue. I think it's important for the commission to go on record in this forum saying that we did this all publicly and intentionally, and that I believe that everybody's vote at July 11 was motivated not by any lack of fidelity to their fiduciary duty. And on September 15th, for that matter, I believe that every commissioner has always acted in their voting in a way consistent with their fiduciary duty without anything going from themselves or themselves. And I believe that our staff and Mr. Borden has always been acting in exactly the same way. Now, that being said, we've got the compensation committee report and the consultants will be making reports that we'll be getting, I presume, in January or late in the latest month.
We have the RFP out. I don't know how many will.
And I think it's perfectly sensible to defer further consideration of this matter until then, and I'm going to withdraw my motion, but restate firmly that I believe the commission is acted properly, and this board is acted properly and entirely in connection with this issue. And any implication to the contrary is wrong. There's been no backdoor attempt to do anything.
Motion's withdrawn. Do we have to take any action on that? We'll be in that discussion. Okay. So let's move on. Next item that flows from that is the need for a technical adjustment on oh yeah, I guess we have the question of we hadn't moved to approve the minutes from the September meeting.
Was that carried over? The question was whether the minutes were to be carried over?
Yeah, so I guess the question for the commission is, are we prepared to approve the minutes or do we want to carry them over, the September minutes?
I don't know the approval of that.
All right, so I have a motion, do I have a second?
Only if you promise we never, ever have to see him again.
All right, so it's been duly seconded. Further discussion on the minutes from September? Hearing none, all in favor? Opposed? Hearing none, motion carries. Did you vote on that? You just abstained.
I'm just having a meeting, sir.
Put him down as an abstention. Okay, next item that flows from that is that there's an issue related to just a technical adjustment because of the July 1 date that needs to be fixed. So I need a motion for, or I'm asking for a motion that staff be empowered to make the technical adjustment so that the pay conforms to the requirements from the Comptroller General office. So moved. Do I have a second? Second, all in favor? Okay. Huh? Yes. Yeah. Next item on the agenda is a report of the audit committee. The main report that the audit committee has is last week we conducted interviews. again, we run an ad. Deloitte helped us narrow the field down to, along with Sarah Corbett, to 4 qualified candidates that we brought in for additional interviews. I think we had a good pool of candidates. We're in the process of narrowing that down further and hope to have further information to report shortly. That was a carryover from yesterday. And the next item on the agenda would be asset allocation review with NEDC.
Mr. Chairman,
Yes.
can I make a suggestion, please?
Yes, sir.
We've got matters we're going to vote on. Now, it's 11:30. I've got to leave at 1:30. We're going to lose our quorum. They won't. I was going to suggest that we move the matters, the investment matters, that we can vote on ahead of the asset review. But we'll still have 4 or 5 days, so it really doesn't matter. But I was just thinking that I've got to leave at 1:30 and 11:30.
And NEDC promised me they can get it done in 30 minutes.
Okay,
so
fine.
we're going,
No problem.
I think we're good.
Mr. Chairman,
Yes, sir.
before you start, I'm gonna have to leave at 11:45, because I have to be in federal court in Florence at 2,
Okay.
so I'm gonna excuse myself.
Okay.
I would like the record to reflect on one of the investment matters, that I think is on the agenda, American Timberlands.
Yeah.
Where I hear, I would abstain on voting on that, because one of my law firms likes title insurance and does title insurance for companies, and American Timberlands might go to that same title insurance company, and I'm sure he would like the business, so I'm going to abstain on voting on that.
Okay.
All right, I'll be here with that.
So,
Just serving as a quick preamble, one of the services that NPC provides back to the commission through staff is asset allocation. As part of this, NPC, we do annual forecasts on all the various asset classes that are available to you. We, like all the other consulting firms in the country, will give you what we will call a mean variance optimization. So right now you have a 7.5% rate of return. So we'll put all these asset classes together to figure out how we can build an optimal portfolio for you that way. So ancillary services that's made NEDC sort of special in working with your staff over the last few years is we built that out, additional building blocks, including things like risk budgeting, which you've heard us talk so much about. Tim's going to have a couple slides on this in a second. We've also built out other services like scenario testing, and I'm getting somewhere with this. In 2009, right after the correction, Bob and I worked together with Tim, and scenario testing, basically stress tested your portfolio for holes. And one of the gaping holes that we saw then in early 2009 is you really didn't have an allocation, direct allocation of things that would protect you in a higher inflationary environment. So we came out of that, it was a recommendation, an approval of asset allocation that had a 5% point allocation to what we call liquid real assets. The way that's been implemented is through tips, global inflation and bonds, and then as of yesterday, there are presentations on commodities. And so that was sort of the third piece of that, and it's finally getting implemented. So that's scenario testing we look to do for you. The final piece of this, which you heard about today, is liquidity testing. So we've done a couple of liquidity analyses of your portfolio to make sure that no matter what you invest in for the long term in terms of the liquid assets, that you're going to be able to maintain enough liquidity to pay your benefits and these commitments. And so that's a crucial exercise. And there's some endowments in the 2008 that actually almost blew the endowment up because they couldn't get out liquidity. So that's asset allocation. We provide it back to you. This morning, in just 15 minutes or so, Tim McCullough, my colleague, partner with the firm, director of research and over strategy, is going to walk you through just big picture how NEDC views the world on that and some of our thoughts going into 2012. So, Tim.
Great speech. All right. So we've broken this up into a review of 2011, and in by review, I mean just showing you what we were thinking going into 2011. And what our assumptions were generally, so you can frame that for how our assumptions might look in 2012. We'll then take a look at the portfolio, look at your expected return and risk from a target and current allocation perspective, and then some risk budgeting analysis, as Brett mentioned. And then we'll give you a preview of our 2012 themes, what direction we see our assumptions going, and our working draft of our observations on markets and client action. And then I'll turn it to Rhett to talk about portfolio. So, leading into 2011, our expected returns had dropped significantly, almost a full % across most major asset classes, at least 50 basis points, basically across the board, except maybe for private debt. So a significantly lower return environment over 5 to 7 years. We had stronger relatively stronger 30-year assumptions, but those had come down as well. So hitting those 8+% return targets we viewed as being very challenging going into 2011. Not much has changed in 2012. It's been a very tumultuous environment. You've had the European debt crisis, you've had the credit downgrade in the U.S., political gridlock, all kinds of issues. And when you look at that, someone mentioned this yesterday in the macro panel, we're really where we were at the start of the year. I guess after this week, probably not, but at the beginning of this week, the S&P was about flat year to date. So if we just take that as our reference point relative to a year ago, we wouldn't change much with our assumptions, maybe up it a little bit because we had an expectation of a 7% return. So the big thing we wanted to focus on going into 2011, and you've done some of that, is focusing more on portfolio structuring, especially for a portfolio like this, where you've made some really good high-level asset allocation decisions to bring that equity risk down and have pretty good balance across equity, fixed income, and alternatives. Now that you've got those buckets at the high level well set, start to think about structuring opportunities. So I know I got ribbed about it yesterday, but increasing your emerging markets exposure within your equity allocation. Thinking about how much credit you want in that fixed income book, how much is nominal fixed income versus inflation linked, and then alternatives even within the private markets, how much equity versus how much debt, how much real estate. So our observations were, as I said, a lower market return environment. We expected macro and top-down factors to continue to drive markets. We haven't seen that next round of quantitative easing, but just having that come off was definitely restrictive to the market. So not having more quantitative easing dominated the markets early in the year. And then we viewed the global currency regime under stress. I wrote a paper earlier this year about thinking towards hedging developed currency risk in your portfolio. It's a risk that goes relatively unrewarded. It just adds volatility. So using an overlay manager like Russell to manage some of that, we think might be productive going forward. We really like emerging currencies over the long term. I know Bridgewater has a negative view in the near term, they said yesterday, just because of risk aversion and sentiment. But if you look at those relative to developed currencies over a 5 to 7 year horizon, we see a lot of upside there. We saw it going into 2011 and still see it now. So I think you've done a nice job looking at these actions and taking advantage of these. You've maintained discipline and have had pretty good balance across your risk budget, with just over half your risk coming from equities relative to 5 years ago when it was 95% from equities. You've done some of those structuring decisions, and you've continued to build illiquid strategies. I think that the opportunities in illiquids are evolving. A couple of years ago, it was all about credit, U.S. credit in particular. Now looking forward, those illiquid opportunities are probably more in structured strategies and in European distress situations. I'll jump ahead to your portfolio. Numbers are kind of small here. For the current target, looking at the expected return and risk, Red mentioned this, you're at a 7.5% expected return. This was at the beginning of 2011. Looking out 5 to 7 years with 11% volatility, that 30-year return, so over a much longer time horizon that is appropriate for setting expected return and discount rate for public pension plans, an 8.8% expected return. From a current allocation perspective, with some modest underweights to equity, GTA, and alternatives, and a higher position in cash right now, a slightly lower expected return and slightly lower standard deviation, but roughly in line with targets and with expectations. If I look out now, I'd say our equity assumptions roughly the same, maybe a little bit higher. Fixed income assumptions down once again significantly. If you look at the 10-year Treasury at the beginning of the year to now, it's down about 60 basis points. Spreads are up, but in the investment grade space, not up to the point to offset that. So yields in general are lower, and yields in fixed income are the driver of your return. If you look at your starting yield and your return 5 to 7 years out, so 6 years out, there's a 0.9 correlation between your starting yield and your expected return.
How much, you'll give us this nifty chart, the actual study, about how the allocations are for our rate of return of 8%. How much of a change is it now that we're at 7%? Now that we have different targets, how does that affect the allocation?
Now that the target's different?
Yeah, well, our assumed rate of return is 7.5%.
I know where we are.
It moved around some from 8 to 7, from 8 to 7.5.
Okay, so more reflective of this.
I think his question is, do we need to change this in response to that? Is that the question?
That's right. I mean, as I understand it, our risk policy is based, risk was based on trying to achieve 8%.
Yep.
Now we're at 7.5%. And I just don't know how much of a difference that is. Is it something we're going to look at and see immediately, or?
It's really not different because our expectations had already gone from 8 to 7.5. So it's really the action of the Budget Control Board was almost resetting the assumption to what our expectations were in the current mix. So it's the fact that was reduced from 8 to 7.5. Our expectation of the portfolio is 7.5. So the structure as we have it, there would be no material change like we think it was
make a comment or raise a question like that too. The assumption changed to 7.5, and in the year term, in the medium term, the expected return is now 7.5, 7.3 based on current allocation. But if you look at it, the 30-year assumption, it's still well above 8%. But in my own view, our effort should still be toward the long term and towards something greater than 8% in the long term, with the realization that we are unlikely to get that in the next few years. Is that?
Yeah, and that's what this portfolio reflects.
Right.
It reflects a portfolio that we think
So it doesn't apply
in
in
the near term.
what we're doing.
Right, right.
And our 30-year returns, those have tended to move slower in changes than our 5 to 7-year returns. I would expect those to be down meaningfully this year. But the baseline for that is the 30-year yield. And that's dropped almost 150 basis points this year. So while I wouldn't expect a 150 basis point drop, and I'd expect to still see that above 8%, I think it'll be a lot closer to 8% this year.
And that's it. I mean, you use long-term normalized returns, right?
That's right.
So you're looking backwards.
Looking backward as a starting point, but then looking forward with current long-term
And if
yields.
this came up yesterday, somehow observed before. When you look at the last 30 years, we had some profound things happen. We had a huge tailwind of falling rates. From 15% treasury rates in 1982 to 2% today, 3% today. You also had the globalization of trade and China entering the WTO and this unprecedented opening up of commerce. And you had the technological revolution of the internet and other technological efficiencies. Those three things together really helped provide a big tailwind over the last 30 years. When we look ahead the next 30 years, we have the specter of either just no change in rates, or obviously there's potential for rates over the next 30 years to go up more than down. We've already globalized trades. There's probably potential for retrenchment or almost nationalization. And while there's incremental technology advances in speed and efficiency, the real connectivity has already occurred. So I think it seems that our expectations over the next 30 years should be muted a little bit compared to the last 30 years.
Yeah, and I think our numbers hopefully reflect that. Any future tailwind is going to come from internal infrastructure and demand in emerging markets, much more than more further technological advantage and globalization across developed markets.
So your guess is when you do the annual update in January, February, you expect to see that 30-year expected return slightly decrease?
Yeah, probably closer to 8, 8.25. Still above 8. So I think to your point, still comfortably ahead of that 7.5.
I mean, it don't make sense to me. I just thought there was a higher correlation between the rate that we're trying to see, which was 8%. And I probably correctly assumed that we took certain risks to get to 8%. Well, now that we're at 7.5%, I would have thought there would be some variance and risk, some change in this. I realized that the goals look pretty good here, especially the 30-year goal. I'm all for making those we can. I was just trying to see if it would be different.
I'll chime in on this. I mean, just to answer some of these questions. When it was moved to 8, Bob and I sat down with our software, with all of our assumptions, and what came back, and we had to come back to the commission on this, In the near term, given our subdued asset allocation assumptions, that was an solvable equation.
So you never really went that way.
Yeah,
Well,
that
what we
was,
did was we solved it over 30 years, to Travis's point, to build a portfolio we today. But the next 5 years, it's right up there. This was reported in January, well, this year, 7.5. And so tell us that all you want, but the next 5 years, I can't make the markets go up.
that was an important point going into 2011 for us, that in order to get to that 8% in the near term, the only asset classes that we had above an 8% return were emerging markets, private equity, and private debt. So you had to put almost your whole portfolio with a little bit of treasuries to get to something like that. And so stretching up that efficient frontier when it's relatively flat, when there's not a lot of reward for taking more risk, we didn't think it was prudent. So it's been a more defensively positioned portfolio. So to that point about taking risk, we give you a quick look at your risk budget. This is the current target and the current allocation. So taking those headline numbers of 11% volatility for the target and 10.9% volatility for the current allocation, how does that volatility break down? What are the sources of that volatility? You can see here, just a little over half of it comes from public equity, with another 20% or so coming from private equity, although we conservatively model that as just private equity. Sitting here, we all know there's debt in there, there's more, there's less volatile structures in there than just broad private equity. So probably have a higher volatility than the actuality of the structure there. But well diversified, well balanced, and I think that makes sense with all the uncertainty. It's appropriate to have your risk in a lot of different places. So if the markets do underperform, if there's another crisis situation, an equity market sell-off, you have meaningful exposure on the left to bonds and meaningful exposure on the right to hedge funds, which should hopefully perform better through active management than long-only equity beta.
I don't know if we have it here, but this is a way of reminder, we mentioned this again yesterday, the legacy portfolio that the commission assumed 5 years ago had about 93%, give or take, of the risk in the portfolio was due to equity markets. And so we've systematically, through diversification, reduced that risk contribution to this 54%. So significant reduction in equity risk in the portfolio.
Bob, just to clarify, the 54% is in equity?
It's the risk contribution.
It's okay.
So the 30% capital allocation to equities leads to
50% risk.
a 54%.
So when we used to have, like, when you have 50 or 60% equity, the 80 to 90, 95% of your risk is coming from that 50. So your bonds are less risky.
Right.
So,
but you arrive at that 54% risk with 34% allocation to equities.
30%.
30%.
Yeah, but that doesn't include our private equity.
It does not. The private equity is modeled separately, and that's another 20%.
But the difference between the 30% and the 54%, tell me how you get to that?
It's through a covariance matrix, and the reason why equity takes up much more risk than the amount of capital allocated is because it's just much more volatile than many of the other asset classes.
How do you measure that?
It's our volatility, our forward-looking volatility estimates. So for traditional bonds, we have kind of a mid-single-digit 7 or 8% volatility. For large cap U.S. equities, it's an 18% volatility. So 2.5 times the volatility of bonds. So if you had the same amount of capital allocated to both, the equities would take up much more risk because they move at much bigger swings.
So that volatility number on top of your actual equity exposure to get the
yes,
risk?
and
Yes,
it's simply an expression of the fact that stocks are riskier than bonds. So for every unit of stock that you put in the portfolio versus unit of bond, you're putting in more risk per unit on stocks because they're riskier than bonds.
And then we account for correlations as well. So private equity being correlated with equities leads to a bigger risk allocation across the two. So we're accounting for the multiple dimensions of the asset classes interacting with one another. All right, so I've probably already taken more than my 15 minutes, so I'll quickly go through some of the things that we're thinking about for 2012. This is a working draft of our observations and actions. A continued downward trend in yields, as I talked about. We think that corporate balance sheets look relatively healthy and the valuations are modestly attractive, but corporate earnings are at all-time highs. And so if those earnings start to mean revert, that could that could counteract any valuation upside that's out there right now. So that leads us to be relatively neutral on equities in general.
Just one further question, as far as that assumption is concerned, how would that affect your outlook relative to your corporate dividends?
So we use the current dividend, which is around 2% or so, and we forecast out 5 to 7 years. That would probably be restrictive towards dividends, so I think given all the cash on balance sheets, we would probably forecast rising dividends, but that earnings compression might offset that, at least, maybe not all the way, but mostly, so that we'd probably have dividends roughly flat, I'd say. So generally, we think that credit markets are more attractively priced. You heard that yesterday and this morning as well. We think that the developed market challenges are going to continue. This is a multi-year secular issue, and that's why you don't see a ton of differences in our observations from last year to this year. It's not that we're being lazy and not thinking about what's going on in the markets. It's just the issues that are out there are broad secular issues that are going to take many years to resolve, and I wouldn't be surprised if we're talking about many of these same things a year from now in our observations. We continue to like emerging markets on a long-term basis, like the internal growth of the consumer in many of these emerging countries. In terms of actions, we think maintaining a disciplined approach, maintaining that risk budget approach, something that you've done that we'd like to see more of our clients do is use an overlay manager for risk management and ease of implementation of different asset classes. And something that I hope to roll out and show you here at a future meeting is taking that risk budgeting approach, and instead of just thinking about asset classes, how much equity risk you have, how much bond risk or hedge fund risk, what's your exposure to different economic factors? So how much is your portfolio driven by changes in economic growth, inflation, rates, currency, all those things. And so it's basically breaking down that risk budget into one more granular level to think about the economic factors that drive the portfolio. We continue to think that hedging developed currencies makes sense, and having long exposure to emerging currencies over a 5 to 7 year period makes sense. And similar to what some of the hedge fund managers were saying today, we like illiquid strategies, we like the distressed strategies in Europe as banks deleverage. We also like some of these structured securities strategies that are out there, kind of semi-illiquid structures with more 2 to 5 year lockups, not as long as those 10-year private equity vehicles, but a bit less liquid than the quarterly liquidity of general hedge funds. I've probably taken more than the 15 minutes there, and I apologize. Any questions? For the left.
So real quick, coming out of this, and I'll put some institutional memory back on the table. When we first started here, almost brought them together 6 months apart, one of the first exercises after the constitutional amendment was to revisit asset allocation and solve this 7 1/4 problem that you have, earning 7 1/4. So at that time, if you remember, middle of 06, we just come out of 03, 04, 05, and most of 06, the equity market collapsed. And so our forecasts then were not unlike they are now in what they were to do. And what we were saying is to earn that 7 1/4 naturally in a balanced portfolio, you were going to have to take all this equity risk, and that risk budgeting chart that showed you, you were going to be sitting at 90 or 95% risk. But we said there are other ways you can do this, that you can de-risk the portfolio and still earn that 7.5% or so yield. And so one of the tools back then that we used, that we implemented, we advised on, we counseled on, and Bob ultimately implemented with the approval of the commission, was a tool called Portable Alpha. And so just 7 pages out of 17 that I pulled out here, I'll walk you through sort of what it is, why we did it, and frankly how it worked over the last 3 years. So real quick here. The traditional approach, I think everyone understands that. You buy your equity manager, invest in your equity manager, you buy stocks along, invest in those, trade them, try to beat the market. If they do beat the market, that extra return we refer to in the business as alpha. The general portfolio itself, as it moves in tandem with the market, we refer to that as beta. And that's your alphas and your betas. What the portable alpha approach essentially does is separate those two. It's a way of investing in alpha and getting your beta separately, to the extent that you don't believe that your traditional equity manager in this particular case is going to be able to provide much alpha. They can't beat the market that much or by that larger margin. And so what we did was separate the two. See if I So I put a lot of formulas up in there for the, I guess, the academics and the professors in here that can appreciate it. But it is all formula based in the textbooks. And portable alpha has been around as an academic theory for decades. It's been implemented as a tool for more than 20 years. The largest that I know, institutional name of portable alpha that you would all know is probably PIMCO. A fund that you might recognize institutionally traded is the Stocks Plus. So the sort of institutional example of how a portable alpha product would work, at least with PIMCO's portfolio, is PIMCO realized a long time ago that they were better at picking credit, short-term credit instruments, than the market would provide for you in terms of return. So what they did was create a mutual fund, referred to as Stocks Plus, where if you had $100, they're going to take $5 and get exposure to the equity market by buying futures. They'll put $5 up in collateral to get $100 worth of S&P 500 exposure. So there sits your S&P 500 exposure. The other $95, if you want to replicate the S&P 500 return, what you have to do there is put it back in the discounting mechanism that the S&P 500 futures is discounted off of, roughly LIBOR. So now PIMCO, their genius was to say, we can beat that number. We can take this $95 and instead of just putting it in LIBOR, we can invest in our credit instruments that can outperform LIBOR. And if we can do that net of fees, we just beat the S&P 500. And they've been doing this for, I think, 12 or 15 years now, mostly successful. Well, there are a lot of institutions that decided along the way, many household names that you could read about, their textbooks written, some that we revised to, like Eastman Kodak. You work with Jack Coates here, who did it at Weyerhaeuser, where you could separate that at a plan level rather than at a fund level. And that's essentially what South Carolina has done for the last 3 years. On why you would do it, I think I hinted at it in 2006. Our subdued return suggested that you need to earn some alpha, some additional return somewhere else rather than just trying to get it through the equity markets. And so we advised on and decided to use portable alpha as just another tool to be able to get to that return. This is another example, and the way that we implemented this, it looks complicated, but it's not. The first piece of this, in terms of desegregating the actual allocation itself, beta, that is, all we mean by that is getting your market return. We're going to talk about that. The way South Carolina has done it is hire Russell, who does the synthetic, so they can do swaps, futures, whatever they need to do to get this beta return. The second piece is the alpha return. We've done that collectively here together. NBC's advised on many, Bob has recommended many, and the commission ultimately approved your hedge fund allocation for the most part. And that has become your portable alpha pool. So that's the pool of managers from which we've drawn this alpha sourcing. And so that's the second piece here. You put those two together, the way that Russell's done it, and ideally you have the beta return, the S&P 500 as it were, and to the extent that these hedge funds net up all expenses and LIBOR and borrowing costs and all these things, if they provide some additional return, it stacks up just like that and you beat the market, essentially. So that's what portable alpha is, big picture. So common sources of alpha, I just referenced here. Typically they're hedge funds. They don't have to be. There are a lot of different ways you can do this. PIMCO doesn't use hedge funds. South Carolina does. Part of the reason is one of the most difficult parts of building a portable alpha program is actually the alpha sourcing, actually coming up with consistent sources of alpha that are going to be deliverable. And this is tricky, I kind of skipped over some of these pages, but trying to find the alpha source, the hedge fund as it were, where the alpha that they're delivering is somehow different from the underlying beta. Because if you found out that you invested in this hedge fund, this alpha that you were hoping to put on top of this beta, and you found out that, say, 40% of the total return of this alpha source is actually perfectly correlated with the beta that you just put it on top of, well now, you actually have a lot more beta than you anticipated. And worse, still, you're paying a lot more for this beta than you would be down here, where you're paying like 3 basis points for this, and you're paying, you've already talked about it, like 2 and 20 up here. So that's those are the challenges. So what we've done through time here force hedge funds, we're getting away now from hedge funded funds, but you can't control that beta component as much. So now in the last year, you move to direct funds, so that's the plan. You can control and customize that beta away and find consistent, low volatile sources of alpha to put over that beta, which is much more customizable and controlled. So that's what we're doing now. So here's just real quick in terms of what South Carolina has actually done. We've invested mostly in the sources of alpha, but we're going to continue to work on that and decompose the hedge funded funds into the direct funds. We've hired Russell as the very cheap beta overlay manager, and they continue to rebalance that and look at every single business day market up. Let me see some of this up. This sounds like, as I'll walk it through now, well, this is better than sliced bread, and we know that in the investment markets, there's no free lunch. Everything. And portable alpha is not a panacea either. It comes with issues. When I talk to people for the first time about portable alpha, I tell them portable alpha. When they ask me what is it, I tell them it's leverage. It's usually hedge funds and it's derivatives. Innocent. So the challenges are understanding those complex issues, implementing them, managing the cost, managing the beta, and building to get your mind and arms wrapped around the whole program. And so you see some of the challenges. The output of all of this, and I'll move ahead now because I know we're time constrained. The output for South Carolina since implementation, what we did, this was a fairly complex exercise we just finished up. We went back for at least the full 3 years. We've had this for a little over 3 years now. On a monthly basis, we looked at your entire portable alpha hedge fund pool. And that was a changing pool because you've invested in new managers along the way. So we looked at every single month. We didn't average anything. And for that pool, every single month, we stripped out all fees and expenses that you were paying these managers. We stripped out all beta, so there wasn't a double up on beta. So we stripped that out. Then we stripped out LIBOR, the borrowing costs, which accounts for the leverage. We stripped out everything we possibly could. We did that every single month for the last 3 years. So the only thing we have here is the raw, unvarnished, delivered back to the state of South Carolina retirement system in this program of alpha over those derivative instruments, mostly the S&P 500 to some degree, international markets, over the last 1, 3, and 5 years. And the results of that, for just the last year, it was over 8 percentage points net of everything.
Which, by the way, there's a piece, I don't know if some of you might have saw it, that came up, P&I did their annual survey of funds, and hundreds of funds, corporate, public, private, and South Carolina had the 4th highest return of all the funds they covered in our hedge fund program last year.
So maybe, the bigger number is probably this three-year number, which goes from September 1st, 2008, which includes the market crash in the 4th quarter of 2008. So it includes that. So that's a good input and observation of this program. So you see that drawdown to the hedge fund and the markets, and you see, of course, the retracement of 09, 010, and you see the volatility of this year, all in here. And in spite of all that volatility, ups and down, over that whole time period, it's been a little over 3.25 percentage points net back to the state.
On what, about $5 billion in assets, roughly?
Yeah.
At least, and this is under what we admit is an inefficient structure. It's overly diversified with too many layers of cost.
That's right.
And as we go through with these 4 strategic partners over the next 3 years, I think we make this a much more efficient structure on top of it. So hopefully, at least that part of it is going to generate more alpha.
Yeah, all things being equal, it will never be. One of the fees in that number was the additional 75 basis points or thereabouts that you had to pay the funded funds. And so that number would be, again, all things being equal, 75 basis points higher. That's portable alpha. Hopefully that was 15 minutes.
Is it, okay. We're talking about asset allocation, and I was looking at all the line items, and we're getting down to fleshing out some of the cells that are, in relative terms, really big numbers. I'm talking about commodities and REITs. And I noticed that we're going to vote on some stuff here that we have sort of 30 million, 50 million. I don't have any problem, Commissioner DeLaw, I don't have any problem with any of that. But I was sitting there doing a sort of a matrix. And as we flesh these out, the original concept with all this asset allocation, Bob said diversify. We had to diversify, we knew it. I mean, we were on the edge of the knife when you took over, literally. Like we had diversified, God knows what the way it would look like. But now we are more or damn near fully diversified. You look at commodities and REITs, and we talk about $500 million in each. I think those are the right numbers. And I'm looking at 30 million, 50 million, 60 million. And I look at all the line items that we have under management, and that doesn't include a bunch of private equity people, and then you look underneath each private equity, and there are probably 20 line items there. You look at fund of funds, and there are probably 20 there. There's got to be a balancing point at which we say, okay, I'm willing to forego the alpha of a discrete manager because it's very expensive. It takes more head count for the commission to run those discrete managers. And they're probably going to be, as we place those out, 15 or 20 of them if we work in $30 million chunks. Versus, okay, I'll forego the alpha. I need the diversification. I'll just index it, which is cheap. You don't get market insight with indexes. But I mean, I think there's got to be there's got to be a trade-off there at some point where we just index 2% commodities index and be done with it, and not deal with all the fees and all the legal work and all the headcount involved in managing 5 or 6 managers. And anyway,
as you pointed out, we were on the edge of a knife. Under diversification can be catastrophic for a fund like this, and possibly would have been. But you can over-diversify too. And if you think about it in terms of just the regular Finance 101 stock portfolio, how many stocks do you have to be diversified? There's several studies that would suggest as few as 6 or 8, or maybe as many as 25 or 35. But at some point, you get to diminishing marginal utility really quick, where you're adding more holdings, but you're not getting the contribution to risk reduction and diversification. And as you get farther and farther out there, then you're better off just buying the market. If you're going to try to buy, 250 stocks, you might as well just buy the S&P 500 and forget about it. So you can take that same theory and apply it to the whole portfolio. There certainly is a declining marginal utility, especially on small allocations to anything. And because you are balancing a very restricted set of resources currently, there is absolutely no doubt that we have built a high level of complexity in this portfolio, and it is under-supported by technology, reporting, and most importantly, human resources. So the thing that we need to do, like as we're doing with the hedge fund portfolio, is a great example. As we put it together real quickly, we looked at it in hindsight, said, look, it was a much better trade-off than the long only when we did it, and it worked. And the numbers just show really well. But we have 350 partnerships in there. It's too many. We're not getting the additional benefit of diversification. We cannot, with this staff, be articulate on 350 different portfolios. And you also just expose yourself to, headline risk. One of them, now you own a tiny piece of something, and it, blows up, but you own it. So you'd rather have that, a long enough list that you're diversified, but short enough that you really feel you can look at it. The small investments, in my mind, should be ones that are relatively easy to get your brain around, and you think have a tremendous amount of alpha in them. Because if they're highly complicated or a low level of alpha, you shouldn't be fooling with, $10 million investments. It's total declining marginal utility. So I think at some point you have to take that into account. However, you may, as we found in commodities, for instance, some asset classes, when you just index them, the structural problems with the index are pretty material. And it's maybe not the best example in equities. It's much easier to say, hey, just if it's efficient, just index. And that's essentially what we're doing here. But you may want to deconstruct that a little bit of index money and maybe 2 or 3 strategies that operate very differently than the indexes. Yesterday we talked about the commodity indexes, directionality and everything, and then there's some good other ways, long, short type strategies that take advantage of the alpha available in commodities. But you got to keep that a short list. It's a small thing, it's 2%, maybe you make it 3 to 5, but you don't need 50 portfolios in there. You'll have the same problem of not knowing what you own and can't keep track of it. So couldn't agree more. And I think there's probably several areas, and the hedge fund is first up here, where we need to be trimming the number of accounts, the number of relationships, so we can really do the job that we need to in ongoing oversight and articulation.
I think that, I mean, to Jim's point, I would just echo it. I think that has to be done even at the higher level asset allocation. I mean, 2% doesn't
Yeah, I
move the
mean,
needle.
we could drill all the out that we wanted, is, you know,
I mean, at the higher level, I mean, I really think 5 to 10 is a reasonable number. I mean, like commodities is a lot of work. There's a lot of potential alpha, but at 2%,
It's supposed to be a non-correlated asset.
And it's
right?
not
It's supposed to
correlated,
be kind of
so-
a hedge.
Right.
But if you only hedge 2%,
Right, it hadn't done you any good. Well, it's a hedge with positive expectancy. right? I mean,
it's good.
So,
But
so arguably in your asset allocation, it ought to be a higher number, right? But at 2%, it's not going to benefit you that much, right? I mean, it protects you, I guess, for about 1 year's of payments, right?
my point is, the higher commissions and the headcount involved, we're gonna eat up a lot of that alpha.
Yeah.
In managing those assets. I just wanted to, you know, obviously you're thinking about it, and that's your job. I just want to know what you're thinking.
I think we need to probably simplify things a little bit now that we've got the big bang approach. And I totally agree with Alan. You know, if something's worth doing, it should be material. Tiny allocations to things, no matter how elegant they are or how much they work out, don't move the needle. And if they start consuming, you know, resources, you know, this is what happens with it. The value of a plan, there's many studies that look at plans like this over long periods of time, say, where does the value come from? And we say there's, you know, asset allocation and rebalancing, and then there's alpha. These studies will suggest that 75, 80, 90, 95% of the value of the plan is due to its asset allocation, and 5 or 10 or 15 is due to the manager selection and alpha and cost. Yet we spend 90% of the time on the 10% and gloss over, you know, the nice. So I would suggest that asset allocation is the most important thing, and it should be meaningful to move things marginally, particularly if you got to go into a whole new asset class that requires new skill sets and training and modeling, you know, everything else. You're having to build the infrastructure for something like commodities. Doesn't make sense to do it unless you're going to do it in a meaningful enough way.
Can I ask one more question? Yes, real quick. I noticed when I read through the entire presentation that you haven't really come out with the model for 2012 yet, is that correct?
That's right.
And you're gonna, so will that change? Well, you don't know yet, because you don't know what the.
Based on what Tim just said, we're gonna have some subdued returns, so your outlook is gonna change.
Okay.
Whether we'll go below that 7.5.
So if it moves, it's probably gonna go down.
That's right.
You've got two competing factors. On the negative side, you know, interest rates have continued to fall, so that forms the baseline, you know, and inflation expectations fall, so that you got a very low baseline. Offsetting that, though, is because the market has, you know, sold down so much, you're coming off of a lower base, so there'll be somewhat of an offset, but who knows?
But you'll have all that paperwork.
Oh, well, like the first week of January,
Okay.
we'll have it approved.
That's all.
Anything else? All right, thank you very much. That's it. Next item on the agenda, we'll just keep pressing forward. EPC report.
So this was, we pulled this one out. The bank got us some numbers Tuesday night, so we were able to cobble some returns together. I'm not sure if you can read them in the overhead. So I'll give the commission a quick oral update on what this means, because frankly, these numbers are so preliminary. Half of the plan is an alternative asset. That's not stated anyway. So I'll give you a few takeaways, some of the salient outcomes here. So through September 30th, the numbers we got for the financial composite, they're down a little more than 10 for the quarter, which is about half the portfolio. Your composite, which is completely updated, a little more than 7.5%. That return, just for the quarter, ranked you in the 26th percentile, so almost the top 4 of all the public bonds in the country. That year-to-date number, if you can see this, brings you to about -3.1. Again, which is completely updated.
Rick, can I interrupt you just on a important topic? I've got to say, pass the basket for the staff that treats you so well here, so while Rick's talking, look for the basket coming around. Sorry, go ahead, Rick.
Despite the fact he's talking about a lot.
Yeah, exactly.
Getting back to the ranks here, the year-to-date number, you would see 3.1 here, year-to-date from September, ranked somewhere in the top 30%. And as you begin to look out those ranks, you can see they're all over 50%. You go out to 4 or 5 years. And when you go out more, that long or further, that's before we actually changed and restructured the portfolio. And I can tell you, we did a study with Bob where we ranked your portfolio going back, I don't know, it was 20 or 30 years. It was several decades. And the South Carolina portfolio over that entire time period was ranked consistently between 99 to 98% off. That entire period. And so just in the last 3.5, 4 years now, we've moved that from being dead last to above average to, in many instances, top quartile and top 25. So a lot of this restructuring is working. It's cyclical, but it certainly worked in the context of moving your relative rankings up. So just looking at year-to-date here, a couple of the takeaways. The obvious one, I know you read the Wall Street Journal, but the equity markets in your composite was down 13% year-to-date. We're not going to go through all these managers with the updates because we got another time. But some of the big pictures here, your total equities, down 13.1. The positive attribution on the next page is fixed income was up 6.3. What helped, and I'll show you this in a couple of pages, your global asset allocation portfolio, where you de-equitize. You keep hearing me say this, where we took that equity risk budget, we got all that red and risk, and we moved that down and put it somewhere else. Global asset allocation was one of those buckets where we de-equitized. So I'm going to show you a comparison of that. Another place where we did it was in the hedge fund portfolio, where we de-equitized and put it in hedge funds. So let's look at the attribution around those. Turn the page here, second page in. If you go down to the bottom of the page, you would see the total global asset allocation. You look at across this entire composite, these three managers. So you would start, if you're water, you go 2.3, 3.9, and so forth. I'm comparing those numbers to your actual equity composite. So had you not taken money out of that equity and put it in here, this is what you would have earned.
Or you can put, what page are we on?
It's not in the, it's not in there. Okay. This was just, it's the very bottom of the page. Right there.
Is that it?
That's it. Just move over a little bit.
To the left?
Not to the right. To the right. That's too far.
A little bit.
But is that double on it?
Yeah, that's it, that bottom right.
So looking at those numbers in gray, so this is your composite of global asset allocation, which right now is sitting at about 10% of your portfolio. So we pull this out of equity, put it in here. Reading left to right, that negative 2.3, had you left it in equities, your number was negative 19.9. For the year to date, if I'm reading this right, 3.9, your equity number was negative 13.1. Going out for the last year, the 6%, the equity number was negative 0.4. For the 2 years, 7.5, and going out for the full 3 years, if you have this, the equity number is 31. So across all those time periods, this allocation has beaten that equity number where we had it. So this has been a calm run for. We had even, and with this belies actually, we had a dud in this portfolio that you had to terminate. The performance numbers that is still in here. So we don't take the numbers out, it's going to be fine. So that number is still in this composite. And so you got 3 out of the 4 managers right, and irrespective, you still get a home run. The other, we go to the final page, if we could, this will be the very top of the page, same analysis with the hedge fund, and I'll stop. Yes, move it over a little bit again. That's good, that's good. Yeah, so again in gray here, so you can see the negative 1.9 and going across. The equity numbers, comparing to this from where you took the money, was negative 19.9 versus the negative 1.9, negative 13.1 versus the positive number, negative 0.4 versus a positive 4.8, 7.5 versus the 5.9, and 3.2 versus the 4.2. This helps answer one of the questions yesterday and today, the hedge fund promise, and whether hedge funds are actually protecting and earning money over the medium term. And at least from South Carolina's experience, it's been really positive. This is all net fees. So you got a really positive experience. But diversification-wise, in terms of de-equitizing the portfolio, as well as the relative basis, actually building above average portfolio. So again, this is still preliminary. We'll continue to get update numbers, and in the next 6 to 8 weeks, we'll have private equity numbers in the final report.
And just as a reminder, our structure versus our peers, we have a lower equity exposure than our peers, a higher cash and credit exposure. So what you would expect to see on any given quarter is if the markets are screaming upwards and the world is great, we are going to lag our peers. But when the markets get very volatile and trade down and fear and uncertainty enter the markets, we are going to outperform peers. And that's the real structural positioning we have taken versus the average pension fund, and it's a reflection of the macroeconomic view that the world economies have a lot of shoes to drop still here as this deleveraging continues, and the real volatility of things like Europe and the euro and the like. And I don't know if Jeff was going to talk about this, but just as a data point, we sold last week, or no, 3 weeks ago almost, sold half of our euro exposure. We just looked at all of the international stocks that we had. We didn't sell the stocks or anything, but we took, it was about 750, 800 million, give or take, just in the traditional category. And we sold 350 million euros at a price of, blended price of over 138. It's trading at 134 and change yesterday. So we're looking at that as a, we have dollar denominated liabilities. We invest in different currency baskets to help dampen volatility. But this was a trade where we stepped in and said, this issue that's going on in Europe right now is very problematic and could have a lot of volatility in the euro. So we, and we also, my opinion, that if we do have a real crisis, what you see is despite all of the U.S.'s problems and debt and over-leveraging and everything else, we are still the flight to quality currency. So my positioning here is that there's a lot of problems in Europe, and if it really becomes unraveled, the dollar is going to be the flight to quality. So why have a big euro bet on right now?
Were those sales that you made on direct investments in equities?
No, it's just currency. Just taking the currency. So it's because we have managers now managing all these equities, and they've got companies that they think are going to do relatively better or worse than the market. We don't want to have the transaction costs of selling that or taking their alpha out. We just want to neutralize the currency exposure. Jeff, were you going to talk about some of the Brave trades?
I can.
Well, I don't want to dominate too much time. I doubt you have exhibits there for them. But,
in my head.
Yeah, okay. But we showed you last month at the meetings. We have 3 or 4 major beta categories, like U.S. large cap and EFA and the like, where some of it is indexed. It's synthetic. And we had a choice as markets tail down. Do you want to rebalance? Do you want to buy more equity? Well, we're sitting here saying, the world is so uncertain, I don't know. I mean, typically you'd say, hey, buy low, right? But you're looking at this situation and you don't know if it's low on its way to potentially really gapping down. But by remaining underweight, you run the risk of, all of a sudden, euro gets solved, corporate earnings look good, and the market screams up real quick on you in a quarter and you were out of it. So how do you have your cake and eat it too? Because volatility is so high right now, the premiums of volatility, and when you buy an option, there's really several factors that affect the price of the option. The dividend stocks, the strike price, interest rates, volatility is one of the key components. We were able to enter into a set of paired trades where we buy at-the-money puts, and we buy at-the-money calls, and then we sell way out of the money calls to finance it. It costs us nothing, no cash, cashless trade, but it creates this payoff pattern where in a band, and it ranges in different markets and contracts from maybe down 5 to down 10%, to up 5 to up 10%, we make money either way. The cost of that, the risk, is if the markets go way, way up, we truncated it because we sold calls. But we can replace that long equity exposure at that point because we're a natural long holder. of these things. So we've created a lot of optionality in the portfolio. And I don't know, you know what the notional amount of all those trades are now, but it's got to be close to a couple billion.
Yeah, and where we sit today, it's about 2.2 billion.
Yeah.
And the value, if you just fast forward the markets at their current levels to maturity, no further changes, the improvement over the traditional long ownership of the asset class is on the order of about $100 million right now.
So we've got about 12 to 15 million in the euro trade and $100 million of value added in this trade that we've generated just in the last 2 months. And it's been, you know, the opportunities, that this volatility that allows us to do these option trades. In a normalized, calm, and trending market environment, that band you get gets squeezed down so much that, you know, it's really not an interesting trade. But today, it really is. So we're in a position, as we walk in, watch the market open each day, and it's been, you know, up 3, down 3, up 5, down 5, up, you know, it's just doing this every single day. We've got $2.2 billion worth of trades on right now that it doesn't matter. We make money if it goes up 5, we make money if it goes down 5. It's a very elegant solution that is just available to us because of the current market conditions. So those are the kind of things we like spending our time on and should be spending our time on for this portfolio. And it's, you know, generated a significant amount of value added for us just in the last 2 months. And I should recognize Jeff in particular has been spearheading on staff a lot of that and has done a tremendous amount of work in that regard. So kudos. Anyway, do we have any other performance things that we need to throw out? Or?
I will be redundant with Brett, so if we need to move on.
So, Mr. Chairman, in order to...
I'll say if we can just move on and then,
yeah, so...
Just receive their,
yeah, if we can just receive the written reports.
I'm also having it posted out on the, it'll be copies.
Okay. Yeah, just make sure we get copies for the minutes material.
Okay, so then that brings us to item 4B, the Bridgewater PAM amendments. Nancy, do you want to handle those or someone or David? Okay.
The staff, commissioners, the staff has recommended that pull back some of the cash account that is currently in Bridgewater. I don't think I have any presentation material for this. So the current structure of the Bridgewater account includes a cash component, and the recommendation is just to basically relocate that cash back onto the retirement system balance sheet. So it's really just a technical change in the structure of the account, but when we do that, it does require revisions to the IMO. And so the recommendation is that we, I guess, what the proper term is for Nancy and for Robert, but we need to enable them to revise the fee structure as well as the target risk structure for the account that's stated in the IMO.
So make sure everyone understands it. They have this pure alpha strategy, and it has a certain amount of risk and variability in it. And then if you just buy it outright, you got to live with a bigger variability. They'll sell a version with lower variability, but it's the same exact portfolio. They just add cash to it to dampen the volatility. Well, there's almost really no reason for us to tie up cash and liquidity with them for that purpose. So there's no change in the portfolio. Just when we first did it, we said we'll dampen it a little bit. We can dampen it here.
Fee structure the same?
Yeah, well, you actually, the blended fee structure is the same. The dollar amount's the same. But when you take the cash away, you got to pay them more on the loan.
Yeah. So in the IMA agreement, it's stated on a percentage basis. So the dollars stay the same, the corpus goes down, it goes up. So
The amount of use, but the fees.
Right, exactly.
The checking cut's the same. Okay.
so the motion is along the lines of authorizing the chairman to negotiate and execute any necessary documents forced upon approval for legal sufficiency by legal counsel to implement the recommendations. And to be honest with you, I'm not exactly sure specifically which document, but
yeah,
it would all be consistent with what the recommendations are.
So moved.
Got a motion, do I have a second? Second, all in favor? Aye. Motion carries. Next item, private equity.
Yeah, we have two to consider today. The first being Green Equity Investor 6. I believe Mitch Cobb is going to address that. And it's in page 278. Is NEPC's number 305 staff.
Red number, which is
Yeah,
down.
red 278 and 305.
Thank you.
Before I get into Green Equity Partners, I just want to take a moment and give the commission a little bit of background on the two managers that we're looking at today. As I was going through the analysis, I found some very consistent themes across both of them. Both groups have over a 20-year history of top quartile and top decile returns. Both groups have got strong management teams that have led both the funds and the portfolio companies through some tough times. Both have a proven process for sourcing, researching, and selecting top-performing transactions. Both have an established investor base of pension funds, sovereign wealth funds, endowments, and foundations as investors. Both groups create value for the investors through the improved operations and through growth of EBITDA, not through multiple expansion or financial engineering. Both groups have done a great job fundraising over the last year and have been able to retain and acquire new investors during a very tough time. And both groups have been vetted thoroughly by NEPC and have been signed off by them. So I'll hop in quickly into Green Equity. Green Equity was founded in 1989 by Leonard Green, based in Los Angeles. The current management team has been in place since about 1992. Most of the managing directors have came out of Drexel Furman. Two of them worked for DLJ for a short time and then joined Green by 1993. The 20-year performance has been great. Investors had invested in Fund 1. They would have acquired a 37% IRR and 2x return across all the previous 5 funds. There's been a low level of team turnover. It's been very consistent from fund to fund. They primarily invest in the retail market, but they have also done some investing in aerospace, distribution, and healthcare. They're currently raising Fund 6, which is going to be probably a $6 billion fund. And my recommendation today is that we invest $40 million into the fund with an $80 million sidecar. The reason for the sidecar is to take advantage of co-investment opportunities that will also be able to help our allocation in terms of buyout. So in light of that, I'll open it up to questions from the board.
Travis was the commissioner?
Yes, Travis was the commissioner.
Yeah, and I support really interesting things about them is they, they have really strong credit analysis coming out of Burnham, but their investment also in the retail space, which is about half of them, really focus on businesses that cater to customers of high education levels, like Whole Foods, for example. So where, the economy right now has got 9% or so unemployment, they're the sectors they focus on, and customers for the sectors they focus on are 5% unemployment. So purchasing power is affected by unemployment going here as much in that country.
What's the dynamic of step down in fees?
That's what they have put in place. We're paying 1.5% uncommitted during the investment period, and then they step those fees down. The idea behind it, from their standpoint, is the fact that they anticipate raising another fund, and that they're going to generate management fee income off from the future funds, and they don't want to stick it to the existing.
So there's 1.5 to 0.7.
Yeah, it'll be steps down to 1.2, I believe, for the first 2 years of post-investment period, and then for years 3 and on, it steps down to 0.7, and then if it goes into an extension period, I believe the fees are waived after that.
You just turned 20. I like it. Usually 2 to 20.
They're very reasonable on the fees, and considering the performance, it's definitely an advantage.
Good. I know it says industry folks, you mentioned that intend to invest approximately half from the consumer sector, do they have any direction as to what the other half of the investment?
Yeah, it'll go into healthcare, like distribution centers, and then also into aerospace. So they have some diversification in the fund, but the fund value historically has always been driven by the retail sector. And then they focus on those other three sectors, as it's appropriate based on economic conditions.
And it tends to be like 85% in the US and 15% Canada, maybe some of the rest of Europe.
Not a lot in Western Europe, but there are, yeah, possibly. There's another group that operates very similar to this in Western Europe called Land Capital. They too have done well, but it's not something that we're pursuing at this time.
And what is the leverage?
Leverage, they'll put a little bit of, they'll put no leverage on the fund. Okay, but they will have leverage on the companies that they buy. But they're only buying companies that produce an 8% CAGR year over year. So if they're not seeing a high growth from these underlying companies, they're not going to pursue them, not with a lot of leverage.
But there's no leverage in the fund?
No leverage on the fund. So they're raising $6 billion fund, so they're not going to add leverage to that fund and take it to a $10 billion fund. They're going to keep it at $6 billion, but they're going to put leverage on it at the company level, which is not uncommon for providers.
And the co-investment portion, that would be, decisions on that would be made with your own internal investment committee?
Yeah, it'll be
So it'd be an inside car, and you guys could handle that internally?
Yes, we can.
Okay. I'll make a
You have a recommendation, do you have a motion?
Yeah.
Motion, do I have a second? Second. All in favor? Aye. Was that for both or just?
No, that's just for green equity. I'd like
Yeah,
to-
my motion should reflect green equity.
Sorry about that. Didn't mean to interrupt. Okay, I'd also like to discuss BC Partners. BC Partners was founded in 1986 in London as part of Barings Bank. Over the years, the group has invested over 13 billion euros in 79 investments across 8 funds. They primarily focus on Western Europe, but they've now recently expanded towards the U.S. as well. They've weathered previous downturns in economic cycles, including the collapse of its parent corporation. If investors had committed money in Fund 1 and had stayed in all the successor funds, they would have made a 38% IRR with a 2.9 times return on invested capital. Every transaction needs to be approved by a 10-person board, with any one member having the ability to veto the transaction. So all 10 members have to agree before they move forward on investing. There's been a very low level of turnover on the team. They've got a very consistent team. They've currently raised euros for this fund, and I'm recommending that we commit 30 million euros to Fund 9.
Mr. Chairman, to our
Yes.
presentation yesterday on Europe, they really do stay in select countries that are sold in Germany. They are actually, they're not going to, almost solely are stuck from the definitely are going to be in Greece and Spain and what, Portugal and so on. They're very selective.
That is a very good point. They do not have a country allocation to each fund. They don't say, okay, we got to commit 10% to Spain, 10% to Greece, and sort of thing. It is predominantly throughout Western Europe, and that does include the Nordic countries as well, which have historically done very well in recent years. And now in the last half of Fund 8 and going into Fund 9, they're also expanding part of their allocation to the U.S., and I think that's quite frankly to diversify away from some of the risks that are becoming rather apparent in Europe. So we've had a number of discussions internally about whether or not we should commit to BC. As part of those discussions, we have parceled back the amount that we would want to commit. Originally, I was thinking closer to 50 to 70 million euros, and through the discussions, we've knocked it down to 30. Also, in light of those discussions, we are going to probably resize our commitment to Apex Partners that I got approved in September, which also focuses on Western Europe as well. So we're pulling back a little bit, and we're being rather prudent about it. But we're looking at the team and we're saying, look, they've had a lot of success over the last 25 years. It's always been top quartile and top decile. The fund that's returned the worst has been about a 2x, and we'll take that any day of the week, from other funds. So we're being prudent about it, but we want to move forward with it if the commission so decides.
Mr. Chairman?
Yes.
I feel compelled to make a couple of statements here. I'm going to do something very unprecedented. And before I do it, I want to, to all the staff and Dr. Pritchett, apologize for just saying this extemporaneously. It's been gnawing at me. We've really struggled internally a little bit with this and both APACs because we started due diligence on this 3 months ago. And the first half of the year, things look like there might be on a bit of an uptick. And I think about the cycle, the economic cycle, and when distressed and restructuring is really attractive versus, when buyouts are attractive. And buyouts, typically, you want some economic tailwind. You want to be coming, out of a cycle into recovery. We are, in our annual plan, we are pretty much at or over by a variety of measures our buyout target. We're underweight in some of the MES targets. And I've just been questioning the timing and cycle. And I did it last month with APACs as well. I felt like, man, European buyouts, really, now? And we actually tailed that one back, and I wanted to do some more information on that whole cyclical thing. And then this was in the pipeline, which is now a large buyout in Europe. And we tempered it down. I'm sure Dave wants to pinch my head off right now, but we talked about this in several investment committees and cut it down a good bit. And I was marginally comfortable with that. The way the world has changed just in the last 3 or 4 weeks, and hearing what I heard yesterday with the macro panel, I'm very concerned about a prolonged and deep recession in Europe. And with this type of strategy, I think this team is top flight. And I think when buyouts are going to be in favor, this is a team to do it. My concern is, and I think they're smart enough not to go deploy capital at a bad time. And they certainly have an incentive not to because they're charging fees on committed capital. So there's no hurry on their part. My concern is that we get into a prolonged recession in Europe and we're sitting here with fees running on this thing, and they do either one of two things. They either invest too early in the cycle or they just wait, but we've really got this dimension of time that's muted our IRR. And I have mixed feelings about this. I think it's a top flight firm, and I think if the cycle is near a bottom now, which even 3 months ago, it looked like Europe might be, bottoming, but my gut is eating at me on this right
But their investment period is what, 2 years?
5.
5 years.
It's a long time.
Right, yeah.
They should be able to buy.
So, I mean, the depression was 33 months, normal bad recession would be 20 to 30 months. I mean, I think that on the horizon of this fund, it would be fine.
That's the rationale.
Right.
That's the rationale. They have 5 years to wait it out. They're going to have to do really good to overcome the lost time and compounding fees, but they have shown in the past the ability to do really good.
Will they do as 20 years?
It's 1.5.
Wow.
So I'm not trying to poo-poo, I just feel compelled to say this.
Europe's going to take it. Good Holland analysis, last minute analysis, I wrote down 4 challenges about this investment. 2 of them are exactly what you're talking about. So I share your same concern. But we are talking about a 5-year investment period and so on. But they are major concern, no doubt about it.
Well, your concerns, and I think they're perfectly valid after listening to what we heard yesterday, shares of it. It's that gnawing and the uncertainty. But again, do we want to miss potential upside, which Alan's talking about, maybe in a 5-year? So would it make sense to alleviate some of that fear and risk by maybe taking down commitment?
And yes, and that's one way to deal with it. We kind of already dealt with it a little bit internally.
We've done that, and actually, Bob had asked me to do a little research, in terms of committing to buyouts during tough times.
So what are we proposing now, 2880?
30
million
euros. $40 million.
Yeah.
$40 million.
30 million euros, right?
Yes, correct. 30 million
Yeah.
euros.
Yeah.
Oh, $40 million.
Currency guy, man, you're right on it, Jim. I said, your currency guy, you're right on it.
We're talking less than
I am not throwing my body on the tracks to stop the decision. I just felt it's just no unhappy and I wanted to say it. I hope I'm wrong, you know, but, you know, this cycle seems so uncertain as to how deep and prolonged it might be.
Yeah, I would take
I think you'd have to be ready to close with rocket sleds attached to it.
I mean, I'm inclined to go ahead and do it. I mean, markets like this compress valuations, right? I mean, having cash with the smart team to put it to work.
I feel
or a
alleviated
reasonable
because I've
amount of
expressed
time.
my concern.
Team that's gonna, hold back to what they think it's a little bit now.
Is this fund where we have to pay, is this a fund where we're simply?
Yeah, you know,
We have no
this is
discussion on
right. Exactly.
what the investments for nothing.
We're backing the team. If we're gonna make this investment, we have to have conviction that this is a team and that their process is proven out and that, that the 10 people that make the decision for BC Partners to move forward with an investment know what they're doing and that they're, that they're intelligent and that they're capable of doing it.
And if you look
Take it from the pessimistic view, if we were half wrong on this, is that, how bad is that?
Yeah, so look at page 273. 273 is their track record in their prior 8 funds, and they're all good, and all double digits. Fund 8, of course, came in at 05, so, that was fighting a lot of headwind. So I can say this too, that they clearly have a track record that's very strong, and obviously these are competent people. If there's an offset concern to that, you got a team now that, started doing this in '87, and you look generically at private equity funds, and you usually find that, first fund's always a little questionable, but usually around funds 2, 3, and 4 is where they really hit their sweet spots. And then when you get to fund 9, 10, you got a lot of, people kind of aging, you might have some difference of opinion, and things can erode. I think more of this is the economic headwinds that they have faced. But, it's clearly a good team with a good track record. It's all an issue of timing and it's impossible.
Can I comment on, back up on something on that? They have done some transition of management. People some of the founders that were there in '87 have transitioned out of the group and they've gone to the second generation. And the second generation has been able to maintain the same discipline and the same process that their predecessors have, and it's showing in the results. You don't just go into BC Partners at a senior level. You grow from within, and you have to be there a good 10 to 15 years before you're getting on the investment committee and being involved with some of the decision making. So it's go ahead.
One further question, that in your discussions with them in terms of going forward on their investments or potential investments, the valuations that are they down considerably, measurably, 10, 20, 30% from prior investments, so that do you have enough measure or margin of significance that you would give you a greater comfort feeling than if you were doing this, say, 2 years ago, or a year ago?
I have more comfort. I'll give a qualified answer here. I have more comfort today knowing the valuations of these companies that they could potentially buy have come down, and that this group is well placed in the market to pursue those transactions and be able to acquire them. It may not be the highest price, but they may bring the most to the table to add value to those transactions and add value to those companies going forward than they would have, say, 2 years ago, 3 years ago. So that I have conviction on. The big problem is Europe in general and the euro. And I don't think this group is going to go out and make foolish investments just to make investments. I think a big risk, though, is that they may hold off while we're paying fees on our committed capital, and they're sitting on the sideline saying, look, now is not the time, or they're focusing back on opportunities in the U.S., which they have the right to do, and start building out that portion of the portfolio.
So even if we're, so even if the investments per se were to be good and smart investments, if you value the euro, which is materially substantially.
But
That would impair our returns.
if Europe goes into a recession, it could potentially impair our returns depending on how quick they put money out. They're not going to put money all out in the next year or even 2 years. I would bet that they would probably do it at a pace of probably 10 to 15% for the first 2 years, and then put out more money in the last 3, possibly asking for an extension on the investment period if needed. So that's
Until they call the money, we don't have any currency exposure anyway.
correct.
You have currency exposure on your commitment, though, if you're committing in euros.
Yeah, you
So you'll
commit
have
euros,
pressure on your
but-
commitment, but not
if
on your
the money's
actual.
not called,
Even pre-call, you
But
got.
if the money's not called, there's no money invested,
We don't
so.
hold it in euros.
We're not, yeah.
It's just volatility with your commitment.
So there's not a lot pre-call.
I sort of come down the side of Allen, and the fees, think of it as an option. You don't get a free option. And so if you think of the fees, okay, we got a call on buyout for 5 years in Europe in case things fall apart. We have confidence in the team, and we're going to pay for an option to get that, and that's what we're doing.
And we maintain our vintage year exposure as well, so.
That's the way I feel about it.
Ed just asked me, how much skin in the game do they have? And the typical private equity firm has partners putting in 2%, these guys putting in 4%.
It's in the terms on the last page, is
Yeah.
just where I have that stated.
So do I have a motion?
Yeah, I'll move.
Got a motion, do I have a second? Second, all in favor? Aye. Carries.
Thank you, gentlemen.
Next item is timber.
Harris County?
Did you want to speak just from an asset?
Yeah, there's two, the next two deals are, the next two deals are things that have been sourced, internally that are, regional in focus. They are not part of a top-down, approach of, asset allocation and sub-allocation and certain strategies. So they are, submitted for your consideration. And the first one, American Timberlands is best described as an actively managed land portfolio that has a timber component. As we heard yesterday, buying just raw land itself for development right now is maybe not the best timing. But the strategy is a multi-use, multi-revenue strategy of active land management. I won't jump ahead to Nexus yet, but these are two internally sourced deals that we've done due diligence on, we've discussed exhaustively, and we're trying to get to a point that we either fill or kill on these things, just so we can make a decision, move ahead or move on.
So just to build on that point, to speak about them, both of these are not traditional, direct fund allocations like the two funds that Dave just presented. Both of these managers are in unique positions in their evolution where we are able to negotiate structures and terms that I think and salaries are more favorable. But just to speak to American Timberlands and Timber first, if you step back and take that top-down approach and think about timber, which has a commodity component and has a real estate component to it. Red, I think the commission with NEPC several years ago when we were doing our asset allocation looked at timber as part of a kind of blended commodities real estate allocation. Traditional timber, which is timberland investing through timberland investment management organizations, or TIMOs for short, has several problems which I think made NPC and the commission hesitant to put money to work there. The easiest two are structure and fees. So these things are 10-year plus, sometimes 15 or 20-year lockups, consistent with what the underlying assets yield and the way the underlying assets should be managed. You typically manage trees on a 15 to 25-year rotation. So really, really long lockups. The returns that most of these TIMOs have generated have been between 5 and 10% from an IRR perspective over time, and most of them charge 2 and 20. So if that 5 to 10% is the return from the trees and a small amount of land value appreciation, instead of the 2% and the 20 on the carry significantly eats into it. So that was kind of some rationale as to why timber didn't make sense. American Timberlands is a very different strategy, and let me kind of back up and speak to another point before I get into it as to how we met these guys. This is South Carolina-based manager. They're headquartered in Columbia, have an office in Pawleys Island. It's a southeastern-focused timber strategy. The team has been together since the mid-2000s, 5 or 6 years, and they originally approached us when a lot of the large timber companies, Georgia Pacific, International Paper Company, et cetera, they used to have large land holdings and figured out that they weren't supposed to be in the land business. Their equity holders weren't paying them to be in the land business. They were paying them to make paper and other timber products. And so they divested themselves over about the past 10 years of most of their land holdings. And American Timberlands, the two key timber principals, Dan Stuckey and Tom Rowland, came out of Tom worked for Georgia Pacific for a long time, and Dan worked for International Paper, so they knew those companies really well. And they were pursuing a large timber tract that was coming out of their International Paper portfolio. And so they approached Bob and staff several years ago, and with that opportunity, which was a long bidding process, and they ultimately, because of some of the ways they wanted to manage the land, didn't end up getting that tract. Anyway, we've known these guys for a while. What is interesting now, over and above the structure that we conceived, is that it's timber and timberland investing is more of time and place now than, as the American Timberlands guys will describe it, than they've ever seen in their careers. You've seen land prices that are severely depressed. There's a lot of distressed selling going on there. In fact, we've looked at several of the properties that are kind of in the pipeline. You visited one with me where banks are foreclosing on these assets. People that have inherited a lot of land from family trust or whatever, that have used that land as collateral for lines of credit, and now find themselves in distressed situations where they're either being foreclosed on or they're having to sell that land. So land valuations are depressed. Timber prices right now are roughly where they were about 10 years ago. So you haven't really seen a lot of gains there as well. So I think timber prices are depressed as well. So manager with an attractive structure, I think it's a common place. So that was kind of what made it initially attractive. The due diligence process that we've gone through, that I've gone through, primarily in kind of leading our consideration here, started in December of last year. The discussion I just took you through from the top down is kind of my first thinking, but the due diligence process has been extremely thorough for these guys. So one of the risks with a firm that's a little bit smaller, and which is why we've been able to negotiate such favorable terms and structure. One of the risks, obviously, is that they don't have a track record of 10 prior funds. They've got a track record really of one fund that's consistent with what we could do. They've got a track record of several investments. They don't have a back office of 100 people. So there's some. I think one of the key risks that I have become comfortable with, but it is a risk, is the risk that this firm isn't an institutional quality firm, which is somewhat qualitative. But to try to address that, what I did was interview several TMOs, from assets under management from $7 billion to $500 million. Interviewed several firms in the Southeast that are trying to do a similar strategy to American Timberlands. Uniquely enough, as broad liquid asset markets have sold off over the past, or sold off in 2008, 2009. A lot of investors, retail investors, nearing retirement, want their money in safe assets. They don't want to experience 08 again. And several retail financial advisors are making recommendations to their clients that timber is a safe place to be. Land values are depressed, or you're probably going to be able to sell it for at least what you got in it, and trees keep growing, so there's continued yield. So there's some managers in the Southeast that are pursuing a similar strategy and are starting up funds to take advantage of that market dynamics. So I interviewed several of those as well, and what I've found were that there were a few very attractive things that American Timberlands does that other managers don't do. Hence the recommendation. Number one, a lot of the big TMOs outsource virtually everything that they do. It's guys with smart guys with Harvard MBAs, some of them with forestry management licenses, but they're sitting in an office and they're outsourcing all the land management, they're outsourcing all the real estate brokerage, they're outsourcing all the marketing for the properties, all the timber harvesting, etc. American Timberlands does all that themselves. So not only are they aligned with you in terms of having an investment in the fund that you're contemplating here, but these are the guys that are actually doing the timber cruises. They're watching the timber harvesting companies to make sure that they're selecting the trees in the right size range on a given tract. They're not outsourcing that, and so they have money in these investments, so there's much better alignment of interest there. And I think that is why, if you look at their track record, they've generated better returns than the average TMO, and I think that's one reason why. The other thing that I think is attractive is that and Bob teed it up well, is that this is kind of a land management play, but with an underlying timber hedge. So the trees don't stop growing; they yield 5 to 8%, depending on how good the manager is, a year. But the land management part of it, these guys have a real edge in, and I really haven't seen anybody from TMOs down to the smaller guys that is able to replicate, and that's in non-timber revenue sources. So if you look at their track record, there's a project in there called the Loamy Aggregates Project. They bought a timber tract that they knew had aggregate, had sand on it, and so they managed it as a timber property, but they carved off the part of the property that could be mined and created one of the largest, most modern sand mines in the state, in the southeast. One of the other properties that's shown in their track record is a portfolio of investments, and it's the one that's most consistent with what we're contemplating, which is a portfolio in Horry County, South Carolina, where they're developing the largest state wetlands mitigation bank in the state, and they're monetizing that and selling it to the Department of Transportation over about a 5-year period, which is roughly a $10 million return. And so these non-timber revenue sources, and there's some other ones like hunting leases and pine straw management and things like that, but they're esoteric and they're kind of hard to get your arms around, but they're very meaningful from a return standpoint. And these guys monetize those kinds of revenue sources better than anybody that I've seen. The other thing that's attractive about them is the target deal sizing that they invest into, which is from about 1,000 to 10,000 acres. And roughly what that is the spread between where the TMOs and the REITs can invest and where the retail guy can invest. So the retail guy doesn't have $3 or $4 million to put into a property, which is they trade from $1 million to probably $10 million in that 1,000 to 10,000 acre range. The TMO that's managing $1 billion has got to put money to work in chunks. I mean, they can't afford to do the due diligence on a $3 million investment. They got to put it to work in $50, $100 million chunks. There's kind of a wholesale to retail play there, where if you buy a tract in that range, you have the option, as you put it into a portfolio, to go to market with the whole portfolio and sell it to a TMO if that's the best buyer for the property, or to split the property up and sell it into the retail market, which is the ideal solution. You're going to get probably higher valuations that way, but you're kind of hedged in between, and you can play the space. I guess that's kind of my rationale from an investment standpoint. You can also speak to some of the classic reasons why you would want to do timber, uncorrelated source of return. It's beat the S&P over the past 10-year period, et cetera. Just to speak to the structure, and then I'll stop. American Timberlands has invested one portfolio for a private equity group called the Brookdale Group. They invest in private equity. It's a real estate investment group that's out of Atlanta, and that portfolio is bigger than what we've conceived here. And so they're still kind of an emerging manager. And so as a result, knowing that if we make a $30 million commitment to them, it's a significant change in their business and their business model that may launch them on other things, we've been able to negotiate some very attractive control and transparency and fee structure with him. And the one that, I mentioned that earlier, one of the risks is that the firm isn't an institutional quality firm, which, that is certainly a risk. Have become comfortable with it, but to address that, and that was a concern the staff had as well, what we put in place is a provision that allows us to revoke their investment authority. So we give them investment authority on the front end, and if they drift from their strategy, if they drift from the investment guidelines, it'll be in the LPA. If they don't perform, we have the ability to revoke their investment. Similarly, at the end of the investment period, there are targets built in whereby if they don't achieve certain return targets, the first one being the preferred return, the 8% preferred return that we've negotiated, then we have the ability to remove them as the manager of the asset. So I think that from a structural standpoint, those are two key things that give me a lot of comfort. The fees, classic notes 2 and 20, this is 1.5 and 12. And from a transparency standpoint, again, to address the control feature where you may want to revoke their investment authority if they don't do what they say they're going to do. Before they acquire a property, they have to disclose to us some basic details about the property. It's an investment memo that's probably going to be 3 or 4 pages, but that's just to ensure that what they have said they were going to do, what they promised to do, is what they're doing. So I'll pause there for any questions. Again, this is for informational purposes. The commission does not have an allocation to timber currently, so this is kind of up for discussion.
I'd like to make a couple observations that probably relate primarily to the investment term, 7-year plus 3 1-year extensions. And as a matter of background, I inherited far less than 1,000 or 10,000 acres of timber a few years ago. So I followed the market a little bit, and there's no question timber prices are depressed. The other point I want to make is that there are mainly 2 uses of timber, 2 big categories. One is tied to construction. So construction needs to recover before you've got a good market, prices go up. The other major market is various paper products worldwide, and of course you got a depressed worldwide economy to some extent with a couple of sections. And as Alan pointed out, well, maybe that turned around far less than 7 years. But think about construction and so on, and relate it to the terms here, in terms of thinking about whether the prices are likely to be up within this term, which I hope they are. But anyway, that's
Yeah, I can say, I've looked at this, I spent some time with them. This, just as it relates to South Carolina, it's a very big industry in the state, and there's a couple of TIMOs already here, I believe, and a couple of years ago, one of them came through, and to Travis's point, just sort of the economics that they had initially done with me is that, at the time, this is back probably 06, I'm guessing, right? We were talking, timber prices were running about $1,000 an acre, right? And I said, well, how much of that's actual yield from the wood that, you can generate out and sell into paper, and how much of that's just land option value on home development, right? And about $400, somewhere between $200 and $400 was what I call what you can actually cash yield out of the asset, is what they indicated to me. About $600 at the time, because home, to back to Pritchard's point, homes were selling a lot. So at the time, about $600, a lot of this stuff was really sort of speculative value, for lack of a better term, on it. So that was kind of a couple of years ago. Since then, the other development, back to the point, the big guys have largely spun off their timber assets, and most of them trade as public REITs now, right? So there's a pretty good test liquid case of what the yield on these instruments should look like, right? Weyerhaeuser spun off their assets, and there are a couple of other timber REITs, that trade publicly in the market since then. And then there were some other developments just as the paper business consolidated, there are fewer mills and different things like that. So with all that kind of background, this group came across, I mean, the principals definitely know the space. They seem like extremely resourceful guys. To one of the comments that we heard earlier, in trying to get that cash yield out. And so and Ed and I talked about this as well, is that, okay, if they can really buy on that cash yields that are significantly better, because we're going private here. I mean, this is a classic private versus public. If they can buy on the cash yields that give us a sufficient premium over the public marketplace, then it would seem to be, I mean, there's pretty clear pricing or a benchmark against which to kind of measure it. With a smaller firm, I mean, a lot of these things he talked about, and there's key man risk, so do we want to carry key man insurance? I mean, I think there's some additional things to think about here, but, this was one that, when I kind of looked at it, I think it's important, for several reasons. One, it's smaller, so, there's more risk, operational risk, other things. The other thing, it's in state. But these guys seem pretty resourceful, and it's a marketplace that now I think they're pretty good, transparent public benchmarks against which to measure them, that with some of these other controls, and look-throughs. I mean, I think giving a pretty good look at what is the cash yield, and if we really focus on buying assets at a good cash yield rather than a speculative return, I think it'd be at least as good as bonds. I mean, kind of where those REITs are right now is kind of between 4 and 5% if you look at them publicly. So in a private asset like this, I mean, I think we'd want at least 35% premium to that. So you probably got a cash yield investment of 5 or 6. But I mean, those are just kind of my comments and observations. But this is one I definitely think is important that we're all behind, just given the nature of the investment.
Can I ask a question, and maybe, Harry, fast. What's I mean, we have a 30, 50-year liability date. How long does it take a ceiling to go from pulp to soft timber? Do you know? 30 to 5 years, 5 years of pulp, 5 years of pulp, and 15 to solid?
From like pine.
I don't know.
From
40, 50, or timber.
You're talking about from being able to sell it into the pulpwood
Because
market
I'm
versus
just
salt
looking
timber.
at crop, right?
Salt
And
timber
as they cut soft timber or pulp, they plant a seedling.
Yeah, and almost typically become salt timber when they're about 18.
18, okay, I didn't know.
And I will say, the other sort of point that is interesting, but I mean, Clemson graduate, valedictorian, I believe, in forestry services. So
Yeah, he was in the forestry services.
He came to the, forestry services was valedictorian at Clemson, just as a, another FYI. But what it's worth.
One more question. You can't really insure against fire and wind except in diversification.
Yeah, they basically said it's not worth doing. It's just, you can do it. They say it's just typically not worth the cost.
Yeah, that's exactly right. There's some management things that you can do, fire lanes, ditches, water running, all that kind of stuff, pesticides for bugs that you can do from a management perspective. But and staff asked me that question as well. You can insure against those things, but it's typically very expensive insurance.
These guys, weren't the ones to improve the curve on it? They'll sell out partials whenever they're ready, and then wait to get an investment.
Oh, no. Yeah. I mean, one of the things that is different about these guys versus a TIMO is that a TIMO manages from the perspective of growing trees. So they buy an asset, in year one, almost immediately or 6 months in, you're getting your cash yield, and you're just yielding over the whole period, 15 years. And then at the end, you have this big event, and it's at the end of your investment period, and you get all your money back because you're selling it. Well, if you commit today, you have no idea if the market is going to be like in 15 years. And that manager is forced to sell into that market because you're in a commingled fund with a bunch of other people. That's what they promise. That's what they're contracted to do. They have to do it. These guys, what they have done, and exactly what is contemplated here, is that they'll sell opportunistically. So we're going to manage the properties like a TIMO would, where you start getting that cash yield. But if somebody comes along tomorrow and offers them double their money for 100 acres of a 1,000-acre parcel, and they can sell that 100 acres without affecting the timber returns, maybe that's something that they're not planning to harvest for 15 years, or that shouldn't be harvested for 15 years. They'll do that. So your return distribution, instead of jumping up and being flat and then going like that, is more of a bell shape.
And if I could add one other thing to that, for the cash management, both of them, one for Georgia Pacific and one for International Paper, served as purchasing managers. So there's some peculiarities on the negotiations that I think these guys clearly understand from the other side of the table on how to negotiate if you're actually selling timber. You know, those companies. So there's some contractual things that they talked about that I think were interesting there as well.
Yeah, both Dan and Tom managed over 1 million acres of procurement for Pacific Tracts.
I'm glad to support it. I have to say this because of my earlier comments. This is a small investment because of the drawback that we have. Somebody's got to watch it, you know, week after week after week and get too many of those, and you know, it's powerful. Use that analogy. But anyway, but I like the control aspect of it.
Any further discussion?
I like Jim's comment because we both look at CRT pretty daily, and observing that balance sheet is a little more difficult than this balance sheet, but you're right.
Yeah. So do I have a motion?
So moved.
Do you have a second?
Mr. Chairman?
Yes.
Request for information, is the
Oh.
motion?
Yeah.
Those 3 parts?
And I will walk through this now.
Yeah.
Thanks for bringing that up, Robert.
And he's got a question.
I'm just
No, I didn't. Okay, so you're bringing it to approve the investment. I thought this was a general discussion of the.
Well, I guess technically we're supposed to have a motion, a second, then discussion on it, and then vote. So this was just technically gets to discussion. We're running a little backwards there, actually.
Would you like me to speak to the motion?
Yeah.
So, again, the memo is for information purposes, discussion. If there is a motion, this is what I envision the motion is to read. Nancy, please help me if I'm off here, but it would be a $30 million commitment. But we would also need to fill in, to the motion the waiver of the limitation that we have in investing in commingled funds, that we can't be more than 25% of the fund. The other thing here is that there's a benchmarking issue. I think that there's extreme basis differential between this and our commodity benchmark and this and our real estate benchmark. So it would be my recommendation to the commission if they decide to make this commitment that we benchmark it against the NACREEF timber.
Against what, I'm sorry?
The NACREEF timberland index, which is an index built up. All TMOs report into it. It's made up of the timberland.
All right. So can I get the motion? The second down.
Yes, sir.
The second. Do I have a second?
I'll second.
Second. The only thing I would add, I think given the long nature of the assets and the principles, we probably ought to ask for key man insurance policy where we're the beneficiary.
We have
Not if something happens to them, we're going to have to go find someone else to manage this stuff we just bought. It's just a kind of a practical matter. I don't know if we have any thoughts on that, but.
We can include it in the closing terms, which
Yeah.
you're going to sign anyway.
Yeah.
Can we do it that way, Nancy?
Yes.
Okay.
And anything else?
If they don't do it, I'm not totally, yeah, we gotta have it. I mean, that was.
Most included.
Only part. Yeah. The two principals, yeah. Okay. So, all in favor?
Well, there are 3 partners. One's the financial guy.
The one's the financial guy, we can replace him, I'm not worried about that. I'm worried about the dude walking through the woods. All in favor? Opposed? Okay. Motion carries.
Alan, do you want to?
Yeah,
Would you like me to jump in?
why don't you take first crack at it since you have
the thing we looking at for the amendment. So this one is not your traditional fund either. Nexus Partners, some background. We first became, they first kind of got on our radar screen and became initially attractive as a result of a co-investment that they presented to us. So Nexus Medical received a commitment in 2008 from the South Carolina Venture Capital Authority. $20 million commitment. They invested all that $20 million, and now find themselves in a situation where they've invested, as Nexus Medical Partners, as that entity and that group of partners, they've invested 3 LP funds. One of them was a co-investment fund that co-invested alongside the other 2. So they've invested 3 funds. They're managing the investments in those funds, but they're in a situation now where they don't feel like they have the time to go out and raise another big venture capital fund. And so as opposed to doing that, the investments that they have now that need to follow along capital, which one of them was presented to us, the company's Lab 21. But those investments, they are going into the GP market. They're talking to other VC sponsors. They're raising capital through banks, et cetera. But knowing that we participate in venture capital and knowing that we are here in the state, close to Lab 21, presumably, they present that opportunity to us. Initially, that opportunity looked attractive, and it still does. There are a lot of tailwinds at the back of that investment, from a personalized Medicare, regulatory, compensation based on results in the healthcare industry, et cetera. Some tailwind behind that investment. It looks attractive. There's no structure in which for us, to close it, we don't have a structure in place. We struggle with that on several things. So we found ourselves in a situation where there was an attractive co-investment that we wanted to act on, but there wasn't a structure in place. So the logical thing was Nexus, being Lab 21's critical partner, could create a structure for us to invest in Lab 21 alongside Nexus. Nexus would help us in our due diligence process. They're very strategic to the company. It makes sense. So I started getting to know the Nexus partners and getting to know Lab 21, and as a result, this has been brought up for discussion today. Some of the things that should be pointed out about this potential investment. The Nexus partners came together in 2004, founded the firm. Bob Fleming joined about a year ago. This group of partners has known each other and been investing together for over 20 years, with the exception of Tom Hancock, who met these guys about 10 years ago, through a series of different funds. And venture capital is very clubby. They tend to go into deals together to mitigate risk, to help with the due diligence process. That's why it seems really technical, et cetera. So these guys have known each other for a long time, been investors alongside each other for a long time, and I think that longevity speaks to the relationship that the partners have, a consistency of process, a consistency of decision making, et cetera. Over their careers in venture capital, the returns that they've been able to generate, I haven't looked at them on a quartile basis, but are consistent with or slightly better than what venture capital returns are. So venture economics measures returns across all, the entire private equity spectrum, specific to venture capital. Their returns have been consistent with or beaten that benchmark. So they've been pretty good investors. The team also has a pretty diverse background in terms of the healthcare spectrum. They've invested in pharmaceutical, far on the end of the risk spectrum in terms of the riskiest investment that you can make here would be preclinical trial, pharmaceutical, biotech. They've done that with very limited success, and that's not going to be their focus going forward. They've invested in medical devices. They've invested in different healthcare therapies, medical equipment, healthcare services, et cetera. So very diversified from that perspective. And I'll use Lab 21 as an example here. As the third thing that can be really attractive is the strategy that they use, which is one where, and I think the returns mirror this, which is where they try to take out as much venture risk as possible and buy companies that are early stage, break even, or may have been, in the case of Lab 21, been profitable for a long time, but never had institutional capital come into it, never had an institutional business plan, and never really thought about themselves as a global company. So of the three funds that Nexus has under management, two of them were raised by LPs from Europe. And so they did this in several situations where they found a company that's early on in its life cycle that is really successful in a local market or really successful in a specific product niche where you can take that business model and that expertise, maybe make a couple acquisitions, maybe go into a couple new geographic markets or a couple new product segments, and all of a sudden it's a completely different business and the growth potential is enormous. With Lab 21, it's a UK-based company that is a market leader in several product niches in several countries, several European countries, and in Australia. So a very established company with established products that's a market leader in those product niches, but has no footprint, no business in the US whatsoever. So Nexus, having some expertise in Europe, having a European LP base, sourced this deal there. The guys being in the healthcare space in the US and knowing it really well, saw an opportunity where they could take a proven business, a proven platform, put it in the US, make a couple acquisitions, grow through acquisitions, because you have to, as opposed to going through the regulatory process to get a license, it's a lot easier if you can just acquire one. So that's part of the business plan as well. But that's really their strategy and their competitive advantage is being able to identify companies where you can do some structural things like that and really grow the company and make outside return. Similar to, that's I'll kind of stop there with the investment highlights as I see them. Similar to American Timberlands, this is a group that has from a back office infrastructure standpoint isn't going to be comparable to the firms that they've recommended earlier. They don't have 100 people in their back office. They don't have some extensive legal team, et cetera. So our investment will make a difference to them as well. So knowing that we had some leverage and that there were some risks associated with some structural risks associated with the size of the firm, we've negotiated very similar rights to what we have with American Timberlands. So ability to revoke their investment authority, and I'll get to this in a second. The fees have not been determined yet, but fees lower than market, terms and controls in the investment period and the partnership term that are better than market, and also to address the firm's size, potentially their institutional quality, which I think is there if they are a small firm. We're going to require them, unless we decide to waive it, this will be our discretion, to find institutional quality co-investment partners with every deal that they do. So VCs are clubbing industry. VCs typically team up to make investments. So they didn't have a problem with that whatsoever. I think for us, that helps us, number one, in understanding the investments. So we have an extra set of eyes on it. It makes Nexus, it puts another set of eyes on them. And it also helps from a sourcing point of view because they're going to be calling other VCs all the time now, talking about the investments that they're doing and talking about the investments that those other VCs are doing and trying to club with. So that was a key control feature that I think helps in the due diligence process and helps to get over some of the concerns you might have about the institutional quality of the group. I see Travis got questions, so we're just going to stop there.
My mind had been wondering, did you explain the legislation to South Carolina?
They are agreeable. So when they established a footprint in the U.S., the first place they did was in Greenville.
This is some place where find it going. Is it something in there that they only realize 16% of?
Yeah. So if you go through, that's probably a place to go. So if you go through kind of the risk section, I'll put together.
What page is that?
That would be. I have no idea on the red numbers there. Here, page. I think it starts on page 5. Yes, there.
Page 342 in our.
Oh, 342. Okay.
Yeah. Second paragraph.
And so
Or third paragraph.
Partners have a long investment history. I mean, they've again been investing in VC for over 20 years. But as Nexus Medical, the investments they've made as Nexus Medical, they've only realized 16% of those. So the ultimate measure of performance being investments made and realized. Only 16% of investments that they made as Nexus Medical have been realized, and so I saw that as a performance risk that,
Right. Again, it's not concern, I think, that I would have a teaching before we talk about unrealized, valuing
There are several due diligence items that need to be checked off on this before we actually make this commitment. That's one of them. So I think what we had contemplated here today is if the commission wants to take action, that we would take action contingent upon some other confirmatory due diligence items. Reference checks, things like that.
Well, the thing that I'm always concerned about is I'm always a little reluctant to accept the guys making the investment telling me what the unrealized appreciation is. I think I have to have a little more independent analysis.
Yeah, I've met them. I was introduced to them primarily to the Lab 21 through the guys from Liberty Life initially. The Nexus Medical also got money from Lab 21, a predecessor company that they had rolled into Lab 21, had actually received money from SC Launch back, and then Nexus Medical had also received money from the Venture Capital Act.
For Nexus, yeah.
Right.
Yeah,
So they're a known entity already to other organizations in the state pretty extensively. And then subsequent to being introduced, it came up because they were looking to make it, one of the portfolio companies, namely Lab 21, was looking to make a follow-on acquisition of an existing business that's already profitable. But basically what they do is, in the case of, there's a bunch of independent labs, right? But to get a contract, with a larger hospital system, you have to be able to process a certain amount of volume, is to acquire additional labs that have specialization. So the issue of the, just tack-on acquisition had come up, but we didn't really have, vehicle. It was a small deal. Back to Jim's earlier question of, is this of interest, and it's a check size issue. But both their portfolio companies are known entities to other entities around the state. Nexus Medical is also a known entity from other pieces. The founders have met on several occasions. To Harris's point, have prior track records, just not as this entity. But I haven't looked at historical numbers and stuff, and that's some of the additional stuff. But the reason for sort of bringing it is because our process runs pretty long. Is there are they have these underlying portfolio companies have now raised money from other outside sources, and these deals are going to get done. It's not. This is one of those that's not going to be there. 6 months from now. So I thought, because they already had touch points with other organizations in the state, it's one we've been working on for a while. It was originally meeting a couple of years ago.
It's been a year.
Were you the commission member on this?
Myself and Travis, because it came up, I initially met him, but this is a private equity, so I immediately introduced him to Travis since he runs the private equity part. So, I had met him on several occasions, and I know we met him once together in Columbia. I don't know if you met him subsequent times.
I think that's it.
Sure.
I wouldn't mind somebody else leaving before I don't see anything wrong with it. It seems like it's a little sketchy in terms of, background and to your point too, Ed. I realize that. I don't know. I don't think they have anything problem with it. Can they wait till February to meet somebody else? I just, that feel better if we had a little more background.
It's completely by happenstance. It's all the name. I did not say this at full disclosure. Sorry, this is the one I've been through this process. Just by happenstance. Yeah. I don't remember the name of it. In fact, back a year ago, toured the place. Somebody wanted to go meet, not about business, campaign.
Lab 21?
Yeah.
Yeah, Lab 21, just a little disclosure, that's one of the, how many underlying portfolio companies they have? 9, 10?
I think it's 10.
10. So Lab 21 is one of their underlying companies. Lab 21, again, was initially funded from SC Launch. As a matter of fact, the first investment SC Launch ever made is now subsequently grown, is in the Next Innovation Center, which is a big development there in Greenville, and they have contracts now with GHS for certain diagnostic testing. So that's one of their unrealized investments that I know just locally that I know they took from startup to revenue producing with actual contracts with GHS currently. So I haven't looked at all the underlying unrealized nature, but I know at least one of them tangentially, the company certainly made progress from where they made their initial investment to where that company is today.
To add some detail, yeah, there are several confirmatory due diligence items that need to be followed up on the track record of validating this. But just follow up on the last one. We actually, and I don't know exactly who they raised this capital from, I'd like to confirm that as well, but that acquisition that Alan was talking about, they're in the process of making right now. They wanted us to, to be in on that investment, to be part of that investment, but because it's kind of trying to find a place to fit it. It's in a different structure, and we hadn't quite gotten there. They went out and raised outside capital. They went through an investment banking process, and they raised capital to make that acquisition. So that should be some independent third-party validation.
Right. So, but I mean, we certainly can make a conditional thing, but I think some of these underlying acquisitions are going to occur, right, probably before we get back together in February and go through the rest of the stuff. But I certainly think we can make it conditional and if there are items like that.
I know nothing about the medical insurance. I said I knew I'd be more comfortable with conditional with maybe Eddie, just somebody else taking a look at it. I don't, you mind doing it? I'm not trying to, I'm sorry, it's really your call.
No, I'd actually suggested that we do it conditional, right? Because there are some open items at the same time. This kind of reminds me a little bit like when we did Azalea, and we knew Azalea had Sage in their pocket. We kind of had to push on that one, right? Because they were a small firm. This one kind of feels like that. There's some,
But I think perhaps we all feel more comfortable if we perform the required due diligence on the unrealized, evaluations of the unrealized.
And I agree with that.
We're talking about roughly 85% of the deal.
And I'd ask them to put it on the agenda because again, like we only meet every 3 or 4 months, right? And I think that can be done, and the staff can do their work, I think, and I think the staff can come see the commission members and present that, right? I wouldn't want to see good investments just because our calendar works a certain way and we don't get back together till February, right? Not to do it. So I agree these are definitely issues that need to be answered.
You could send us stuff out and take a phone vote. I mean, we're not
sure. Okay.
Yeah, I mean, what we've done.
Can we do that?
Right. Yeah, we're always free to convene by phone. So that's probably the better way to do it.
Satisfactory due diligence as noted by.
And reconfirm to a phone.
As related to the unrealized.
Do y'all want to set a quick telephone conference call meeting?
Yeah, I think let Harris get the items together. Why don't we just reconvene by telephone and have no motion? That's kind of
So no action at this time?
no action at this time.
Okay. Just to clarify, that is another one where we have to waive that 25% commitment cap, but another one where we've got all these control features in such that we can turn it off. They drill.
So just as soon as Harris gets the information, the staff will coordinate a telephone conference.
Right.
Y'all, as a form, it'll of course be like a formal commission meeting.
Yeah.
You look better about that.
All right. Next item I have is reservoir.
So I'll be as brief as you guys want me to because I know everybody's hungry. This recommendation is to increase the capacity to the Reservoir Strategic Partnership. And it's primarily to take advantage of 3 opportunities. One kind of merging with energy and power. We heard Joe Brandt yesterday talk about the pipeline of being able to buy quality power plants and arranging long-term power purchase agreements or PPAs with contractual revenues, in the high 20s to low 30s. Big opportunity there in Europe as well as in emerging markets. And the third space is hedge fund seeding. These guys have been doing that since 1992. Have seeded some of the most well-known managers in the hedge fund industry. Just launched their Reservoir Strategic Partnership, which is their seeding fund. They've only made one investment, But there are quite a few talented managers in the pipeline, and we would like to increase the capacity to review transactions in energy and power and hedge fund seeding.
What's our current commitment to them?
300,
And we're proposing going to
up to 750.
up to 750.
Is there the additional, because and just for clarification, the current 300 is allocated into 3 different tranches?
Sure.
Where?
So this would be
that third tranche.
Yeah, well, it'd be increasing the third tranche, which
Okay.
could pull things out of their capital partners fund, their strategic partners fund, which is our main focus.
So
But
that would be 550, that third fund. So we have 100, so you make the
That's
third one.
the co-investment.
Right, exactly.
Correct.
You make that with 550, you get 750 total.
And it's also, gives the hedge fund team the ability to get exposure when it's more favorable to managers that they see, and they can get better terms, transparency, et cetera. So there's Reservoir is very unique in their business, having kind of a hybrid between private equity and hedge funds. So it's a really valuable partnership for us, and having that excess capacity will allow the staff to really look at some very opportunistic investments in a flexible manner.
All right, so.
I'm happy to talk more about it because I love talking about the power stuff, but I know everybody's getting hungry.
Do I have a motion?
Sure.
All right. Do I have a second?
Yes.
Yeah.
Well, after you
Yeah.
second.
Yeah. Yeah, do we have a second so we can get the discussion?
Okay, I just want to be clear. This is an existing.
Yes.
And this is simply an increase in our commitment.
That's correct.
Capacity, yes.
From 300 million to 750.
Okay, this is entirely in the energy sector.
No, it's energy, power, and hedge fund seeding.
Okay.
Yes, sir.
And it's at our discretion, so it's not a commitment, it's capacity. We'll approve
And
each
there's
project.
no fees charged on the.
So any of the additional funds that we are approving would have to be approved by.
Deal by deal in our
Deal
internal
by-
investment
All right,
committee.
The only question I had was, I got lost when we talked about how they were selling the increased bits of, kept calling electronics. How does he do that and somebody else who on that plant wouldn't do that as well? Santee Cooper, they do that every day.
There's very few people that have the financial expertise as well as the operating expertise to go into places like Eastern Europe and emerging markets. And also the leverage that Eastern Europe particularly had on some of these power plants. The net debt grew like this over the past cycle. And a lot of the acquisitions have been made at very high valuations over the past 10 years. So they're able to come in with financially talented managers as well as operators and buy these assets at favorable valuations, so they have the flexibility to be, kind of custom tailored to the end users, desired purchase. So it's really the acquisition and the flexibility of their entrance into the asset versus having owned this thing for 10 years and having 6 times leverage.
Well, and they also aren't doing it in the U.S. I mean, part of the strategy is they go into places where the infrastructure is not dependable or well-built, and then largely around a primary customer, like a Coca-Cola bottling facility.
But I still don't understand why he makes money out of that and the next guy in or the last guy out didn't sell the same electricity. So the guy Santee Cooper is selling, they know when every smelting pot at Alumax comes on and offline, so they're selling extra, right? Well, if I was own that power company, I would know the same thing. So where's it coming from?
They're going into grids that are inefficient, to Alan's point. See, this is a very efficient grid here.
Yeah.
And so the end user doesn't have many options. So it's either, I take power from him when I want it, and I can use it from, say, 3 to 5 p.m. in the afternoon, or I don't get power at that time.
But now most of his power plants were in Western Europe, right?
Yeah, Italy has for example,
And Spain has a couple coming on the market.
So like in Western markets, but where the grid's unreliable, or.
And a lot of the European utilities traded these assets among each other, it's financed by their own banks. So now they really can't make that trade anymore, and the leverage has to come due, and these guys can come in and have a favorable acquisition and a favorable asset.
Right, and then part of it also is like they're negotiating, say, with like Coca-Cola Europe for power in multiple countries, right? So you have to have generation in multiple.
All their end users, they want to be very, very creditworthy. They don't want to have to worry about their counterparty risk.
Further discussion? All right, all in favor? Aye. All right, that motion carries. Now, last item on the agenda. SIP.
This one should be very easy. What we're recommending is that the commission reaffirm the statement of investment objectives and policies. No changes are being recommended right now. It would merely incorporate the securities litigation policy from yesterday.
She said this will be clean.
And the primary reason why we're asking for this specific motion is that the statute requires the commission to review this document at least once a year and reaffirm it or amend it. Y'all can amend it at any time. But this is the first opportunity we've had to get this document in a proper order under the statute. So if this is reaffirmed today, the staff uses that as their guideline in developing the annual investment plan that will be presented to y'all in the spring. So this is our opportunity to get the
Calendar, right?
to get the calendar right and get the horse in front of the cart.
Mr. Chairman, just to amplify what Nancy just said, that she's phrased it perfectly, but no changes are being proposed. Yesterday's action was yesterday's action, no changes are being proposed, am I correct?
Yes, the only thing that would change is
Yes. Okay.
the date in front of it and adding that, that's it.
Right. So,
I have a few remarks.
so can I get a motion?
I make the motion.
All right, do I have a second? On this SIP. Any discussion? No. All in favor?
Thank you.
And I guess from the chair, I'll say we're adjourned by common fatigue. Only if you're sure to do, only on that practice.
All $21. Yes. Somebody did.